some type of a pullback here. It just seems natural and normal, and this is not the reason to exit the market.
It's inevitable that the boost from reopening and from fiscal stimulus will fade.
You will get periods of setbacks in equity markets because, that's simply what they do.
We have to take the move in the market seriously.
The market likes higher rates, and people just don't want to buy into that idea.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is almost the weekend. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene. I'm Jonathan Ferro. Together with Romain Bostic again this morning. Lisa Abramowicz will be back with us on Monday. Here's your price action right now. Up 11 on the S&P to 43.24 on the S&P 500. Tom Keene, yields can rise as well as fall.
Yeah, they can. I mean, crisis over. There's a huge set of research notes out. Everybody publishing early, John, this weekend off of the growth scare we've seen in the last 48 hours. We'll have a lot of different opinions on that. Conrad de Quadros in moments. But, John, I'm looking at the Bloomberg terminal, and it's telling me this growth scare is on the edge of over.
Yields up 5 basis points to about 134, Tom. I think people are still trying to work this out. Many people believe we're at some kind of inflection point. Mike Wilson over at Morgan Stanley believes the index-level correction, Tom, is not behind us. It's still in front of us.
Yeah, I thought Mike Wilson's note was really, really important. The idea he says here is a real correction would be a buying opportunity. To be clear, John, we haven't had that. Wilson's talking we need 10 or 15% down to be his buying opportunity. Not there yet, but he showed some optimism for equities out 1-2 years.
To be clear, we're down about 8/10 of 1%.
It's a plunge
on the week so far.
I mean,
Romain, when you see yields higher, you know what that means. The Nasdaq's lower. The S&P 500's doing okay.
Yeah, the S&P 500 doing okay. You mentioned it down 0.7% on the week. We should point out the Nasdaq basically flat on the week. I mean, what really got hit this week were the cyclical stocks, some of those small cap names, particularly in the energy and in the material space. So I think when you talk about the growth scare, you did certainly see it in that realm. The question is whether people begin to sort of re-enter some of those bets here. You mentioned the Mike Wilson note. He's talked a lot over the last couple of weeks about this idea that maybe people got a little bit too far afield with that growth trade and that giving up completely on cyclicals may have been a little bit premature.
He's calling it the rolling correction. We'll get into that a little bit later this morning.
There we go.
Nasdaq futures down 23. We're down by about 0.15% for the broader market on the S&P 500. Up 11, advancing 0.25%. And after 8 straight days of yields falling on a US 10-year, yields are rising by 4 or 5 basis points to 133.94. Euro dollar firmer. Euro stronger by about 0.1% to 118.57. And Tom, a little bit later this hour, we have got to talk about the ECB's Fed-like strategy. I've got to say, for a lot of people, that was very underwhelming in the last 24 hours.
I love the phrase Fed light. It really had, to me, almost an American or Anglo-American feel to it yesterday. We can dive into that. But, John, what I would look at is how the real yield is slammed, and I'm using that word very carefully. The real yield is slammed from a negative what? 1.02% up 10 full beeps to negative 0.91. It's a huge move in the real yield as you go into your important program this afternoon.
Never mind my program later, Tom. We've got to push forward to next week. Earnings kick off. We get another CPI print in America, July 13th.
Right. Neil Irwin's article I thought was great last night. I put it out on Twitter, and it goes back to the fundamental linkage, John, of earnings to GDP. The heart of the matter is this boom economy and the raging debate of how long it lasts.
Let's turn to Conrad de Quadros, shall we? Bream Capital Senior Economic Advisor. Conrad, next week. Set us up for next week. We've got the earnings. That's going to entertain the people in equities. Then we've got the data. CPI in America.
Yeah, a lot of important events next week. In addition to the CPI report, which I think is likely to show another pretty elevated reading, not as elevated as the prior 2 months, but we're still going to be looking at core inflation readings that are well above levels that would be consistent with what the Fed has termed price stability. But we also have a lot of growth data as well. We have the retail sales report. We have industrial production. Both of those reports are going to be dampened by supply chain issues in the auto sector. But I think the retail sales report in particular is going to show us that the consumer is in pretty good shape, has a significant amount of excess savings that can continue to be put to work. So I think the underlying details of the retail sales report will be solid. And then, of course, away from the data, we have Fed Chair Powell with these Humphrey Hawkins testimonies, and that will be a key as well.
What I look at, Conrad, is the writing to Quadros optimism. The heritage of your work has always been optimistic about an America that will adapt. Do we underestimate the growth of America?
Well, I have heard a lot about the growth, well, a lot of these growth scare stories because of what's happening with yields. I think if there's a fundamental story there, it's just some rising uncertainty about how changes in the virus and the variants might impact the economy. But I think that if we were to have another wave of infections, and we have not seen that yet, but I think there's some concern about that because of the variants. It will be different this time around. We have better health measures to address it. If we look at the economy, we've just come off last week an increase in employment of 850,000, despite the ongoing supply constraints on the labor market. Demand for labor is still there. Consumers are in good shape. Companies are in good shape in their balance sheets. And so I think there's a lot of reason to be optimistic. I think we're looking at a GDP gain this year, somewhere in the neighborhood of 9%.
Wow.
In this current quarter, the quarter that's just passed, that's going to be reported later this month. We're looking at a 9% increase in GDP. For the year, we're looking at a GDP gain of about 7%. So, the gap in GDP relative to the trend that we're on pre-COVID is going to be closed this summer, and then we're going to have another year or two of above trend growth. And I think that that's going to be, something that we should be pretty encouraged about.
Conrad, Bill Dudley publishing moments ago, he's channeling Conrad de Quadros on the labor mysteries of America. He calls it murky. I believe Dr. Dudley will be with us later as well. Conrad, within the labor recovery, will we see wage inflation? Abby Joseph Cohen over at Goldman Sachs was heated that we will not.
I think we're going to see some further pickup in wages. Now, we've already seen some I think, pretty significant increases in wages. If you look at the last 3 months, average hourly earnings are up 5.9% at an annual rate. So, we have seen, if we're trying to get away with the inflation data and the wage data from some of the distortions of last year, so looking away from the year-over-years, if you look at these shorter-term trends, 5.9% increase in average hourly earnings is, I think, further evidence that there is some tightness in the labor market that's not being reflected in the level of the unemployment rate. If we look at the JOLTS report that came out earlier this week, we're seeing high levels of job openings. We're seeing high rates of quitting. All of that to me points to continued upward pressure on wages. Now, on the other side of that, we have the inflation data, which are rising at an even more rapid rate, right? If we get a 4/10 core CPI, which is the consensus forecast for the June CPI, that's going to point to a 3-month increase in core CPI of 8.5%. So, the short run trends, even as the monthly increases are slowing down, we still have these very elevated short run trends in inflation.
And Conrad, though, that still raises the question, though, of how much of that actually feeds into consumer spending here. We've seen several drops now in those retail sales numbers, at least on a month-to-month basis, whether you're looking at the control group, whether you X out autos, whether you X out energy. The trend has been sort of choppy here. And I'm wondering if you anticipate any sort of a meaningful pickup back in some of those retail sales numbers.
Well, one of the issues remain for the retail sales numbers is autos, and that's going to be an issue again next week, where we know from the manufacturers' data that auto sales fell about 10%. Now, that's not a demand issue, and I think that's one of the keys when we're looking at the consumer. This isn't a lack of demand. In many cases, it's an absence of supply because of supply chain problems. So on the retail sales side, I think the underlying details of that report away from autos are going to be quite solid. But we also should remember that predominantly here, the gap in consumer spending is on the services side. And as the economy continues to reopen, we're probably going to see, I think, some strong services spending in the coming months, supported by a labor market that's solid and supported by a consumer that has quite a bit of cash sitting in bank accounts.
Conrad, just quickly, this supply-demand mismatch that's currently developing in the labor market, Bill Dudley this morning pointing out that that's something that typically can be resolved with time. That's one perspective. Another one from Mohamed El-Erian is that you get the price shock and that can cascade through the system, and maybe it's not so transitory at all. Which side of that debate do you fall on right now?
I'm more on the El-Erian side on that because, firstly, the issue is with transitory. What does that really mean? A transitory period of elevated inflation, I think the Fed should be in a better position to excuse that when we have actually had a period of low inflation. But now what we've had, you look at the last 5 years, PCE inflation has averaged 2%. So what prior miss are we trying to make up for now? There really isn't one if you look at 5 years. So looking forward now, we have these issues of the supply chain. You look at things like what's going on with shipping, and look at shipping costs between Shanghai and LA. They're up multiple times of where they were a year ago, and those are still price effects. Even as the Fed's focusing on things like lumber coming down and used car prices aren't going to boost the CPI anymore, there's all of these other price effects in commodity prices and transportation costs, and even, as I said earlier, in labor costs picking up that still have to feed into prices. And I think that's an area that's going to keep inflation elevated for some time. And that's a key, I think, when we consider the fact that we don't really have much of a miss to make up for anymore.
Yep. Conrad, it's good to hear from you, sir. Conrad de Quadros, Bream Capital Senior Economic Advisor. Tom, I framed the debate that way because, of course, at 8:15 this morning, Eastern Time, we'll catch up with Mr. Bill Dudley, the former New York Fed president. 45 minutes after that, we'll catch up with Mohammed on Bloomberg TV as well. It just gives you those two perspectives on this situation at the moment.
What's interesting to me, John, is there's not two perspectives. There's about 5 perspectives here.
That's a good point,
on
too.
the hugely fluid dynamics. What I'm falling back on, John, is I'm looking at the Bloomberg terminal. I'm looking at the correlations or lack thereof of equities, bonds, currencies, commodities. I don't have currency moving this morning, even though sterling under a 138. Oil's not giving me much, maybe mid-range. But, John, to your point, you go to the fixed income market and look at those dynamics, and it says growth scare over.
Yields are higher by about 4 basis points to 133.60. And remain, we talked about it about 5-10 minutes ago, that relationship between this bond market and certain compositions of this equity market still intact.
Yeah, still intact here. And I think that when you start to see these yields come back up, you still have to kind of keep in mind where we are and where we've come over the last couple of weeks here. The growth scare might be over, but I think some of the imbalances that this market's been trying to work through is still going to take some time before we finally get to the end of this.
What kind of growth scare is over after a morning of high yields that have lasted about several hours, TK? You want to make that call? It's 6:11 Eastern Time. We're up 4 basis points. It's over. Okay.
Yeah, John.
Maybe it is. I don't know.
I'm researching here,
in the
John.
process.
John, I'm is Italy really won 33 matches in a row?
Yes. We're on a 30-plus game winning streak. Is it 33 now?
That's like better than the Padres.
We're up to 33. We're doing nicely. We're doing well. I don't want to talk about that game too much. I was talking to friends yesterday. I'm pretending it's not happening.
Why?
Unless we win, of course.
What are you,
43.21 on the S&P 500, up 8 on the S&P. We advanced 0.2%. NASDAQ 100 futures down 40. We're negative on treasuries. Yields are higher by 4 or 5 basis points to 133.77. What a week we've got coming up next week for you. Chairman Powell testimony down in D.C., and we get CPI data, and earnings season kicks off from New York.
Major League Baseball All-Star Game.
Lovely. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Biden administration reportedly will add at least 10 Chinese entities to its economic blacklist. According to Reuters, that could happen today. The move has to do with China's alleged human rights abuses and high-tech surveillance in Xinjiang, the homeland of Muslim ethnic Uyghurs. China has pushed back strongly against the criticism. It says the U.S. and its allies are bullies. Pfizer plans to request U.S. emergency authorization for a 3rd booster dose of its COVID vaccine. That's after data showed it can sharply increase immune protection against the coronavirus. Still, federal health officials signaled that they would take a cautious approach to potential booster shots. President Biden reportedly will encourage federal regulators to reinstate net neutrality rules, according to Axios. He'll sign an executive order that also would make it easier for consumers to comparison shop for internet service. Net neutrality rules bar the blocking, slowing down, or paid prioritization of web traffic. They were repeated by President Trump's FCC. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Our military mission in Afghanistan will conclude on August 31st. The drawdown is proceeding in a secure and orderly way, prioritizing the safety of our troops as they depart. U.S. support for the people of Afghanistan will endure. We will continue to provide civilian and humanitarian assistance, including speaking out for the rights of women and girls.
The President of the United States from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Romain Bostic, counting you down to the open about 3 hours away to get you set up. Here's the price action this Friday morning. Good morning to you all. Equity futures are positive. They're up 9 or 10 points, positive 0.2%, set to take a little bit of a nibble, a bite out of a weekly loss. Over to the bond market where yields are higher. That's really set the tone for the day's price action throughout the last couple of weeks. Yields are higher by 4 or 5 basis points to 133.94. And the euro a little bit stronger. Euro dollar positive 0.12%. TK euro dollar 118.59.
118.59, a little bit of a pop-up off the Lagarde news, but not all that much. We'll get to ECB here again, and Bill Dudley joining us later today. I'm looking at futures up 10, a better tape. Right now, Anne-Marie Horton of Bloomberg in Washington with us this morning. Anne-Marie, to those with a collective sense of history, and I think of the interviews I've done over the years on Afghanistan and on Iraq, it is really not so much buried in the news, buried in the headlines, but we're just sliding away a bit. What has been the Capitol Hill response to President Biden saying, no, we're not going to ask how many more years?
Yeah, well, Tom, that press conference he gave yesterday came under a lot of pressure from the press answering these questions. I think many think that his decision is quite firm given how strongly he was rebuting the press on why they are leaving. Of course, one thing he did say that was key was that it's not inevitable that the Taliban would take over the entire country,
Right.
But he did allude to the fact that it isn't going to be a country that is going to be governed by just one. Right now, the U.S.-backed Afghanistan government only controls about 20% of the country.
I'm confused, Anne-Marie. Who is against President Biden here? Are there Democrats or Republicans saying we need to stay fully committed or partially committed to this 20-year effort?
So it's interesting. The Democrats are certainly supporting it, and a lot of Republicans are as well, Tom, but they're doing so in a much more quieter fashion. Really, what the concerns are is not that the United States should continuously stay in Afghanistan, but the concerns are what happens because if we leave. Is there a planned political handoff? Is it going to be a safe place? We already see Afghanistan refugees really just fleeing the country. One of the key things to keep an eye on is if the Turkish government is going to be able to maintain a strong control of the Kabul airport. If not, what happens there and in the United States Embassy in Afghanistan? So I think it's more from the military part of Washington, just asking these questions about what happens next and how to make sure that as the United States leaves, that they are leaving so in a fashion that at the best way we could support the Afghanistan government.
And Ray, let's stay on foreign policy just a little bit longer. Away from Afghanistan, a separate situation, and let's go to the Middle East and sit there just for a moment. What's the broader strategy there now from this administration?
This administration is certainly keeping an eye on the Middle East. We saw that there's issues right now and discussions with Russia in corridors with Syria. There's also discussions about the Iranian nuclear deal. Well, at the moment, those talks are pretty much just in purgatory. We're supposed to have a sixth discussion. But really the focus, Jonathan, I would say is less so on the Middle East, less so on Europe, and the focus is on China. And you saw that overnight, Reuters reporting that it's already taking aim at another 10 Chinese entities due to human rights abuses. So, of course, the entire foreign policy, they're going to look at every corner of the world, but really the focus of this administration is being tough on China.
This feels incremental, though, Anne-Marie. With the previous administration, they were heavily criticized for the moves they made, but it felt much bigger. What's the approach this time around from this administration, and how different is it?
I think the approach from this administration is to just do so multilaterally. President Donald Trump, and what is so different from President Biden is President Donald Trump took on China very much so as himself, as the own Trump administration, one-on-one against Beijing. What we saw on the heels of the G7 and then the NATO summit with President Biden was to try to get Germany, the United Kingdom, France, all on board in tackling and going up against China.
Emery, let's stick on foreign policy here. Talk about Iran and the idea here that this administration came in with, I guess, the intent here to maybe try to revive that 2015 nuclear deal here. A lot of reports this week here about the progress Iran has made with regards to enriching uranium, and the idea here that salvaging that deal now is a lot harder than maybe it looked a few months ago.
Yeah, there's a number of items going into this Iran nuclear negotiation that make it so much harder. One is that you have a change of a regime. You have Ibrahim Raisi, a cleric that's coming in August. He's sanctioned by the United States. This is going to be someone who has called the Iranian nuclear deal something that is moderate in terms of how much he wants to put emphasis on it. You do have Iran as well at the moment not having those special IAEA monitoring committees being in the country right now. So right now the IAEA is supposed to have this in-depth, detailed security of the Iranian nuclear enrichment, and right now that is on hold. That has not been extended. So there are a number of factors going into if they have a sixth round of discussions that are making it much more harder, that are going to able to actually clinch the deal.
Did we get an OPEC deal in the end? What on earth happened to that? That was the news at the start of the week, and then the week's grown older and no one's talking about OPEC anymore.
Classic OPEC. There's no deal. There's still talks. But the fact of the matter is, and what is so different from last year, is that the market is in deficit right now. So I don't think the market actually cares that there's no OPEC deal. Because if they all start pumping at will, okay, who cares? The world needs that oil.
John, did Anne-Marie come back from London with a British accent?
Why'd you say that?
I hear it, you know.
What do you hear?
I hear a British accent.
Never.
I don't hear the British accent.
But you know, I hear it a little bit.
I've lost my T's since I've been here. I now pronounce them as D's, which apparently is what you do over here.
Oh, really?
So it's not butter, it's butter.
John, I still can't understand one out of 5 words you say.
You still
I
don't
swear,
get it, Tom. I adjusted my T's just for you. I did that just for you.
Does she sound like the BBC or does she sound like Sky? I can't figure it out.
I don't think she's changed.
Okay.
I think she's still got that Long Island twang, Tom.
She's the only one on the show that's actually had tang besides me.
Anne-Marie Hordern, down in Washington, D.C., our Washington correspondent. Anne-Marie, run. That's what we used to say to Kevin every day, run. And now saying it to Anne-Marie. Your bond market looks like this, up 4 basis points on 10s. Yesterday we had a break of 125. It was a brief break. Now we're north of 130 at 133.44. And in Tom Keene's words, growth scare
Growth scare.
over.
Oh, come on.
Your call, not mine.
John, I'm so upset at how apoplectic we get. Down 0.7%, down 1.7%, whatever it was.
Well, to be clear, Tom, in the equity market, sure, at the index level, we're down about 7/8% at the index level. But for the bond market, that's a real move. To see the break of 125
well, the bond market,
that's a real move.
The bond market is so distorted right now, John. It's in no textbook. It's not in Fibonacci. You know, we're making it up as we go.
We can talk to David Kelly about that.
Yes,
we'll do that next. From JP Morgan Asset Management, Chief
He's an Irish
Global
accent.
Strategist. Well done, Tom. You're good at this. 43.25. This is like Sesame Street, isn't it?
It is.
Up 13, up a third of 1%. This is Bloomberg. Live from New York City for our audience worldwide this Friday morning. Good morning. Crisis over, if there was a crisis, according to Tom Keene this morning. That's his line, not mine. Just to re-emphasise that. Your equity market, 43.24 on the S&P 500, advancing about a third of 1%, up about 11 points this morning. Nasdaq 100 futures pulling back by 0.2%. We're negative 27 there. I think you can guess where the bond market is. Switch up the board. 2s, 10s, 30s, shaping up as follows. This is your nominal yield on a 10-year, 133.44, advancing about 4 basis points here. On a 30-year, still sub 2% at 196.85, heading north by about 4 basis points this morning. This is the Treasury curve. I'll talk about that a little bit later this morning. This is what I want to talk about now. Switch up the board and get to Germany. Your German 10-year is still at negative 30 basis points. Negative 0.2299%. Negative 0.299% on a German 10-year. So we had this shift over at the ECB and no one got excited about it, and you wonder why. Well, they've gone from an inflation target of below but close to 2% to just 2%. You would think that maybe that has trimmed the Bundesbank's wings just a little bit, but no. Jens Weidmann, the Bundesbank president, comes out a little bit earlier this morning and says we will not seek an overshoot of that inflation target. Now, Tom, over at the ECB, this is not flexible average inflation targeting, because if it were, we've undershot that target for a decade plus over in Europe, unlike the United States, and that is not what is going to happen in Europe. So what's going on here, Tom? Do they have any control over price stability over at the ECB?
Oh, come on, it's politics.
Can they achieve their target? Do they have a credibility issue? And can they do anything, TK, to get this German 10-year back in a positive
John,
territory?
I've sat in the office with Otmar Issing a long time ago. It was really quite an honor to see the blueprints for the new building a million years ago as they were building the edifice of the ECB. Nothing's changed since Otmar Issing showed me those blueprints. The bottom line is it's a political exercise.
Yeah.
It's original monetary theory with a fiction of a fiscal combined union. And the answer is they're making it up as they go.
And they're still making it up.
Yeah.
Tom, you and I have spent a lot of time over in Frankfurt, Germany. We've got a wonderful team over there leading our central bank
3-hour
conference.
lunches.
They will remember the line that President Mario Draghi used to use continuously, that rates needed to be low now to be higher in the future. Tom, we're pushing 10 years of talking about that. They need to be low now to be higher in the future. There's your future right now in Germany. Not looking so bright, is it?
The 10-year yield, and again, the Swiss 20 years of benchmark I use, that turned to a more negative yield this week. Right now, and it is the research note of the week, David Kelly joins us. He's with JP Morgan Asset Management because he moves away from his expertise in investment and finance and his legit expertise in economics to the human condition. David Kelly talks to us about the reality of his family after the storm, after a horrific tornado, and the Kelly family recovered. David, I love your note and the idea that we underestimate the human spirit out of some form of disaster like a pandemic. Do we underestimate the global growth recovery?
Yes, I think we do. I mean, I think we're so shell-shocked by the pandemic that we are underestimating the impact of these vaccines and the impact of growing immunity around the world. So we've got this, Delta variant. I think that is scaring people. I think the increase in cases in some parts of the United States is scaring people. But if you look at the broad picture is that about, we think over 75% of Americans now have some immunity to COVID-19. And if you look particularly on the coasts, it is declining very rapidly. So we think the economy is coming back to normal. It's coming back strongly. And sometimes people get deflected from that message, but I think that's the broad picture here.
Sum for us the JP Morgan view on off the mat of February ago, this titanic equity boom that we've seen. Does the equity boom continue with this growth recovery?
Yes, I think it does for a while here. I mean, there's still a huge amount of liquidity sloshing into the economy. I mean, one of the things I mentioned in that note is, one of the remarkable aspects of this landscape is somebody's turned on the fire hydrants of liquidity, both on the fiscal side and monetary side, and nobody seems interested in turning them off. So we've got all this liquidity pouring into markets, and while central bankers think about consumer prices, asset prices still are being helped by all this liquidity. So I do think stock prices can move higher on this. I do worry a lot about valuations, particularly for the more expensive stuff here, because when eventually rates rise, I think you're going to have a problem there. But for the moment, I think the economic and monetary background backdrop is very favorable for equities.
You say eventually, David, so let's get into that. I mean, we've gone more than 10 years, I think, now, with the ECB not raising interest rates since the 2011 Trichet hikes. For Japan, it's been a lot longer, David, as well, of zero interest rates. For the Federal Reserve, do you think they could get trapped down here?
No, I think there's a big difference, which is that we've got no fiscal caution whatsoever. I mean, the big problem in Europe and in Japan is they've been doing, half an aspirin worth of fiscal stimulus all the way along, and it's just never got anything going. And keeping interest rates low at these levels does not stimulate anything. So they've been permanently, sedating their economies with these very low rates and anemic fiscal policy. Here in the United States, it's a different matter. I mean, we've got, I still think we're likely to get an infrastructure package, a reconciliation bill passed through. We've got a lot of money still pouring into the economy. We're going to get these first checks on the child tax credit coming in on the 15th of July. For many families. So I think we've got a lot of fiscal stimulus here. And as the unemployment benefits lapse, or the enhanced unemployment benefits lapsed, I think we'll see a lot of job growth. So there's just much more economic momentum here in the United States and a lot of fiscal push. And so I think that's going to get us back to full employment. Inflation is going to stay relatively high. The Fed's going to have to change its tune.
David, in the past week, BlackRock downgraded US equities to neutral. They're looking abroad. Would you maintain a relative overweight to the US versus the rest of the world still?
No, not for a long-term investor. I'd actually agree with them. I think, despite everything I just said, all of that and more is baked into the relative difference in valuations around the world. International stocks look extremely cheap relative to the U.S., and that gap's only grown. So, right now we're booming, but we'll have to slow. Right now, the rest of the world, particularly Europe, it's gathering some momentum here. So, despite what I said about policy, I think economic reality is that U.S. stocks are probably a little expensive relative to international stocks, and I'd want to increase my allocation to international.
David, how much attention are you paying right now to some of the movements that we've been seeing in the commodities space here? I mean, that seemed to be a pretty good indicator of the growth story for quite a few months here. And the last 6 to 8 weeks here, we've seen some tempering in the prices.
Yeah, well, we've seen. There's some areas like lumber, of course, where the prices just got, ridiculously high and have come back down again. But if you look at the overall commodity indices, they're more sort of flatlining than anything else. They're not exactly keeling over here. And I think the other part of the story that has not been present in other expansions in the last 25 years is we're seeing a lot of wage growth. And we've got a statistic on the year-over-2-year wage growth in the United States is at its highest since 1983. If you go through the pandemic and back before it, we've got a lot of wage growth building here. So those things tell me that, we have moved into a new old normal where inflation will be running above 2% rather than below 2% in the United States.
And that's going to be a good thing?
I think it probably is a good thing if it causes monetary authorities to get back to normal, because they're doing a lot of damage to the long-term structure of capital markets and the economy by keeping these incredibly low rates around. And they're feeding a lot of frenzies they shouldn't be feeding.
Next week's going to be fascinating, TK. You're going to have this situation where this market's talking about moving past peak everything, and you'll start to see some commentary from some companies that are talking about the things that David is talking about. Cost pressure, higher wages. They'll have a very different outlook on things.
Yeah, they will. David, I have one final question, and I say this with great respect for your remit over the decades. I don't want to get you in trouble with the general counsel of J.P. Morgan. Can we see a coalesced tax regime out of all these different countries as they speak in Venice this weekend? You're on the Irish watch. I mean, are you kidding me? We're going to have a combined tax regime?
Well, I think they'll agree to something small. I mean, a 15% global tax is not a huge ask from here. I mean, even the Irish are, they're at 12.5, so it's not that far above it. So I think they'll agree on something small. But I do think that we need to think logically about this. The problem is not that corporate taxes are too low around the world. It's ultimately a corporation is a piece of paper. You have to think about individuals and inequality in individual wealth and income around the world rather than corporate taxation. I just think that's a cop-out for people who don't want to deal with true inequality in the world.
David, just bigger picture, what do you make of the US giving up some sovereignty here, some tax-setting authority to have this multilateral agreement on an issue like this?
I like it in general. I mean, I think that we need to work cooperatively in the world on a lot of issues. And this is one that we should work cooperatively on.
And this seems to be the approach of this administration. David, it's good to catch up, sir. David Kelly of JP Morgan Asset Management, Chief Global Strategist. We didn't linger too much on the earnings next week because it will be JP Morgan kicking things off. I believe Tuesday morning, July 13th. We get some CPI data that morning as well. And I'll reiterate that point. Tom, the commentary that we will get from the C-suite of corporate America could be very, very different to the tone of this bond market that we've experienced over the last several weeks.
Radically different. And what's important is the tea leaves we've seen from this selected companies here in the last 2 weeks it looks forward to huge changes, a huge change in tone, I should say, by these corporate officers.
Every single data point, Romain, that you pour over, the ISM, the Guy Johnson and Alex Steele will break at 10 a.m. on any given week. Every single data point speaks to the same theme: scarcity, supply issues, cost pressure, labour pressure. This bond market's going with this transitory theme over at the Federal Reserve, maybe, a segment of it. I wonder what the C-suite's got to say on that debate in the next several weeks, the next month or so.
Yeah, absolutely. And I think this gets to the idea of whether you talk about this as sort of the growth scare, the end of the growth story, or more of this is just growing pains. The idea that this is an economy that's still relatively healthy, but does need to sort of work through some of the supply issues pretty much in every aspect of this economy right now.
We've got to talk about this pandemic as well. We'll do that next with Andrew Pekos of Johns Hopkins Bloomberg School of Public Health, a professor and virologist. And Tom, I'm told that maybe a Pfizer booster shot against the Delta variant is in the making. Is that right?
It's in the mix. And also, we're waiting on younger children. Will there be a vaccination below 12 years old? It's really, John, the numbers are fascinating. We're at 55% or more of 12 years and up fully vaccinated.
Wow.
That's a great number.
A lot to discuss. 6:41 Eastern Time from New York City this morning. Good morning. Equity futures up about 15. We advance a third of 1%. Yields are higher by 4 basis points to 133.60 on 10s, which means Nasdaq 100 futures are just a little bit lighter, softer, lower this Friday morning. What a week it's been. Good morning to you all. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. President Biden's team is concerned that time is running out to revive the Iran nuclear deal that Donald Trump abandoned. There have been 6 rounds of negotiations in Vienna, and there's little sign of when a 7th might start. The stalemate is compounded by Iran's technological advances and the election of a new hardline president. President Biden has defended the U.S. military withdrawal from Afghanistan. The president argued that the U.S. achieved its goals and should not seek to rebuild the country. The Taliban has been making quick gains as American forces pulled out, but the president said it's not inevitable that the Taliban will take over Afghanistan. And a new British study says that most young people face an extremely low risk of illness and death from COVID and have no need to shield from the virus. That backs up clinical reports that children and teens are less likely to be hospitalized or face severe effects. The U.S. is actually one of the few countries offering COVID vaccines to children ages 12 and over. And Bloomberg's learned that Chinese aviation officials are open to conducting test flights on Boeing 737 MAX. That would be a step towards lifting the plane's grounding there after more than 2 years. Even if a test flight is made relatively soon, it could be months before the 737 MAX ban is actually removed. For now, cash is still king at Sotheby's in Hong Kong. A 101-carat diamond was sold for $12.3 million to an unknown buyer using traditional currency, and that disappointed cryptocurrency fans. They hoped the buyer would take Sotheby's up on its offer to accept Bitcoin or Ether. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
You won't hear me champion travel restrictions as the way to keep a virus from entering a country and to keep it from spreading, because clearly we have many, many examples where that simply has happened despite travel restrictions.
That was Dr. Jennifer Nuzzo there, the Johns Hopkins Center for Health Security senior scholar from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowicz is back with us on Monday. Romain Bostic dropping by to help out with some of the price action. Equity futures up 15 on the S&P, 43.28 on the S&P 500. We advance around about a third of 1%. Treasuries are lower, yields are higher. Yields have been lower for 8 straight sessions coming into Friday. Right now, Tom Keene, 133.44. We settle down, settle in, north of 130.
Settle down, settle in. Maybe not all the way back, but nevertheless a more constructive bond market with price lower, yield higher. What we're going to do here is dive to the pandemic and then get back to some important Biden headlines that really have to do with all we do here at Bloomberg Surveillance. Andrew Peckhouse with us with Johns Hopkins. We're thrilled he could join us this morning. The mystery for me as someone vaccinated, Professor, is the idea that if I choose to be unvaccinated, how sick is sick when I get the Delta variant? What's the level of sick we should expect?
Well, the data is really rolling in now that the Delta variant is causing disease primarily in unvaccinated populations. And the disease that it's showing seems to be a bit more severe than the disease we saw in similar age groups at the beginning of the pandemic. So if you're unvaccinated, the risk from Delta variant is greater of infection, and there's also going to be a slightly greater increase of severe disease from infection. So there's nothing good about being unvaccinated when you think about the Delta variant.
Where are we on the vaccination process right now? I follow the statistics. I saw something age over 12, fully vaccinated, 50% as well. Are you pleased with the rate of vaccination?
Every vaccination is a good thing. I would love to see these vaccination rates get much higher than they are right now. We've reached a stage where many of the people who are vaccinated now, obviously they're protected from infection, they're protected from severe disease. We haven't reached those levels that really give us a population-based benefit from vaccination yet. That's that herd immunity thing that you hear about all the time. It doesn't mean that the vaccine doesn't work against you individually. The vaccination helps protect you, but at some level, we get that added benefit that the virus is just so difficult to circulate in the population because of vaccination that even the unvaccinated get a benefit from that. We're not close to that level, and as a research scientist, that's what I really like to set as a standard vaccination goal.
Yeah, Doctor, a lot of talk now about sort of what the next step is for those folks who have been fully vaccinated. Pfizer, of course, coming out yesterday and talking about the idea of a booster shot. The CDC saying that, well, maybe not quite yet here. Where do we stand?
Well, all the data so far from the U.S. looks like vaccination, particularly vaccination with the mRNA-based vaccines, is protecting against Delta variant. So I like the fact that Pfizer has gone forward with the clinical trial to show what a booster will do. I think that's important data to have. I don't see it as an imminent thing in terms of a guidance for the U.S. population. But this virus moves quickly. Variants are emerging fast. And I think the Pfizer move is good in terms of preparing for the future. If we get a variant that's even more deadly than Delta, then a booster may be an important thing to consider. And having Pfizer completed the clinical trials for that is going to be a good thing in terms of helping us be prepared for that.
Professor, it's good to hear from you, sir. It's good to catch up. We've got some breaking news we need to run to. Andrew Peckosh there, Johns Hopkins, Bloomberg School of Public Health. A fact sheet from the White House, an executive order on promoting competition in the American economy. And Tom, it's pretty straightforward, the top line at least. For decades, corporation consolidation has been accelerating in over 75% of industries. It's led, they believe, to a reduction in competition, to higher costs, to lower wages, and they've come out with literally, Tom, 72 initiatives, one by one, to tackle some of these issues in the labor market, when it comes to corporate consolidation, when it comes to prices. You name it, it's in there right now.
This is an absolutely extraordinary document, John. I really think even supporters of President Biden will be surprised by the comprehensiveness of this. What this comes down to, John, is the fear of not monopoly, but monopsony, which is there's such a lack of competition that you can set the wage because there's no place else to get a job. And the first line statistic in a lengthy document is consolidation lowers wages by something on the order of 17%.
So what are they trying to change? Here are some of the lines. Make it easier to change jobs and help raise wages by banning or limiting non-compete agreements and unnecessary cumbersome occupational licensing requirements that impede economic mobility. Tom, you remember the late great Alan Kruger. He used to talk about that often, on how that was holding back wages. So that's just one line in this fact sheet this morning, Romain.
Yeah, and I don't think we can understate really just how broad-based this fact sheet is here. I mean, a lot of people knew that there was going to be a lot more attention paid to some of the big cap tech companies. But this is prescription drug companies. This is banking and consumer finance companies. This is airlines. This is agriculture companies. This is basically every major industry you can think of. The administration is laying out point by point what it says is a level of consolidation that it says is harming not only consumers, but in some cases the workers for these companies as well. And it's making it very clear that it's directing the DOJ, the FTC, and all the other major regulatory bodies that would deal with this type of stuff to target these industries and to target them very specifically.
To enforce the antitrust laws vigorously and recognizes that the law allows them to challenge prior bad mergers. That one's highlighted, Tom, that past administrations did not previously challenge. Just one by one, to Romain's point. Take your pick. The banks, there's things in there on fees. The airlines, they want refunds from the airlines. Make it easier for people to get them back. You just wonder how much teeth how many teeth this particular executive order has, Tom.
There's people that have written about this, both Republicans and Democrats. I think of Glenn Hubbard and Paul Krugman as being two polar extremes in politics who come to the same conclusion on this. John, the way to look at monopsony and the ability to bargain fairly for wages, the classic text, and this is particularly off the desk of the London School of Economics, is think of a rubber plantation in Malaysia or a rubber plantation in Singapore. When you're out there in the getting the rubber, getting the material, who bargains for that wage? Is it the plantation owner, or is it the people collecting the rubber? And the answer is that plantation owner has a lot of power.
Yeah.
What this document says is airlines have a lot of power. Hospitals have a lot of power, et cetera, et cetera.
And he goes through it one by one.
Yeah,
by one. And coming up in the next hour, what we're going to do, we'll head down to Washington, D.C. We'll catch up with Anne-Marie Horder down in Washington, and we'll get you up to speed on what's going on with this live on TV and radio. To wrap things up on this program in this hour, let's run through the price action for you. Equity futures on the S&P drifting higher by 14. We're higher by a third of 1% to 43.27. Advancing there in the equity market as your Treasury market heads the other way. Treasuries lower, yields are higher by 4 or 5 basis points to 133.95. The White House releasing a fact sheet, an executive order on promoting competition in the American economy. Full coverage coming up on TV and radio next. From New York, this is Bloomberg.
Some type of a pullback here just seems natural and normal, and this is not the reason to exit the market.
It's inevitable that the boost from reopening and from fiscal stimulus will fade.
You will get periods of setbacks in equity markets because, that's simply what they do.
We have to take the move in the market seriously.
The market likes higher rates, and people just don't want to buy into that idea.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Can we just have one quiet morning from New York City for our audience worldwide? Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Lisa Abramowicz will be back with us on Monday.
So she says.
Together with Romain Bostic this morning. Equity futures up 15 on the S&P, 43.28. And it's a fact sheet, a readout from the White House that gets your attention, TK. An executive order on promoting competition in the American economy.
Well, they want to promote competition, but I'm going to get right to this, John. There is a magical thing in Western Massachusetts every weekend. It is the Great Barrington Farmers Market. And buried in that 72-point executive order is a complaint of the administration over fair pricing and boosting farmers markets. John, you got to be kidding me. President Biden is going to somehow adjust the Great Barrington Farmers Market?
I've got no idea if that's achievable, Tom. The broad strokes of this particular readout, though, are pretty clear.
Yes.
They don't like the broad consolidation that's taken place in this economy. Over 70% plus of industries of the U.S. economy, and they worry that it's been pushing down wages and pushing up prices, and they want to do something about it.
John, I'm going to do a major shout out right now to Catherine Mann of the academics of MIT and, of course, at Citigroup, and now vetted by the Bank of England for public service there. Dr. Mann, on the desk of surveillance, at least 3 years ago, gave out a primal scream over the consolidation of American enterprise. Yeah. She was right then. She's right now.
These are the broad strokes of this readout this morning. Romain, I know that you'll be focused on the sector-to-sector story.
Absolutely.
The fast food chains, the non-compete agreements. Then you've got the airlines. Then you've got the banks. Take your pick.
Yeah, take your pick. And there's a lot of minutia in here, but it's important because this minutia is actually enforceable by the Biden administration without Congress getting involved. And I think that's why investors really do need to take some of these things seriously here. Also, I think some of the language in here about unionization, about right to work, about the idea of mobility with regards to state licensing requirements. These are huge issues that this administration can bypass Congress to get done. And that's something that you have to be concerned about if you're in certain industries.
In this readout, Romain, it talks about the regulatory bodies looking at past past mergers that have already happened that maybe previous administrations didn't take a close enough look at. What do you think they might be talking about here?
What they're talking about Google, they're talking about Amazon, they're talking about Facebook. We've heard from Elizabeth Warren and a lot of the progressives on Capitol Hill. They've been pushing this idea now long before Biden got into office. The idea here that he's on board with this means that some of those deals are going to be scrutinized. You talk about Facebook, WhatsApp, you talk about some of the Amazon deals of smaller competitors that probably weren't a threat at that time, but were on their way to becoming a threat that were effectively neutralized. A look back at those could have huge implications going forward for how these companies grow.
These are things that could take a long time to sort out. Elsewhere in this particular readout, Tom, there are things that can be done pretty quickly too.
Well, they are. It's an executive order. That's the difference. I guess it's an end around Senate, end around House as well. And, John, with our esteemed guest coming up here in moments, it's just real simple. When does this go into effect?
We'll head to Washington in just a moment. Here's the price action. 43.29 on the S&P. We advanced 16 points, up 0.4%. Yields are higher. Treasuries are lower. 144.11, up by about 4 or 5 basis points. Euro dollar, euro stronger. Euro dollar positive, a little more than 0.1%. Euro dollar 118.59. Let's head down to DC and catch up with Emily Wilkins, our Bloomberg government reporter. Emily, you've had a read. What's your take?
So this is a really wide-ranging executive order. There are like 72 different provisions in here, everything from airline luggage to big tech to drug prices. And a lot of this stuff, as we talk about this reconciliation package that is coming down the line and that Republicans are currently putting together in back rooms, trying to put pen to paper on, we have to acknowledge that the reconciliation process that we're talking about Congress going through is very limited. I mean, this is a process that really deals with the budget, with spending, and with how the government spends money and controls the debt and the deficit. And so these regulations out this morning from the Biden administration really cover a lot of areas that Congress would not be able to touch through a reconciliation process, but deal with those overarching themes of competitiveness, of trying to make the economy a little bit more even for consumers.
Emily, why the kitchen sink approach? I mean, it seems like they've dumped everything into one document. Does that surprise you and Biden watchers?
I don't think at the pace that we've seen President Biden go with these executive orders. I mean, remember the first 2 weeks of the administration, it was every day a brand new executive order, a brand new complex issue. Biden has been around DC for decades. He very much knows government and structure. He's very aware of what they want to do. And he has a White House that is staffed with aides who are also very well aware of these things. So I think by putting all of this into one package, instead of doing a small thing here and a small thing there, they're coming out with a comprehensive message, a message that they want to try to make businesses more competitive. They want to make things more equitable for consumers, and they want to target these variety of areas. Taken alone, any one provision's pretty small. Taken together, they send a much wider message about what the administration wants to do.
John, page 6, paragraph 3, there will not be a gouge for the England-Italy football game.
Oh, thank you, Tom. I'm pleased you looked into that. I mean, it does cover everything. And Emily, to Tom's point, sometimes with these kind of executive orders, it's about the optics and not the substance. What would your read on that be right now?
To a certain extent, executive orders, they're great because it's the president just acting alone, and then they're not so great because the next president can just come in and undo everything you did with a stroke of a pen. So this doesn't really have the long-term stability that you might get through a law. At the same point, you read through this list that the White House put out this morning, and a lot of it has words like encourage or ask agencies to look into or have them go into. It doesn't actually have a lot of very clear and direct, this must be done, that must be done. It's more of having agencies, giving them instruction and guidance.
But Emily, we could certainly divine from some of the people that he has leading these agencies what direction this might go, particularly at DOJ, particularly at the FTC with Lena Khan. I am curious, there's a broader question here about presidential administrations taking this route, trying to do this end round around Congress, primarily because Congress is basically stasis embodied right there. You've seen this with the Biden administration. You saw this with the Trump administration. You saw this with the Obama administration. Is there sort of any sense that we ever get back around to this idea that the checks and balances that Congress is supposed to represent, that does become a factor in how these types of rules, major overhauls of U.S. industries and how these industries are regulated, Congress has a say?
mean, right now, if you look at Congress, look at the tech antitrust legislation that they're trying to pass. This is something that has bipartisan support. You have both parties saying that something needs to be done. And yet you had a mostly partisan bill wind up passing through committee. And now Democratic leaders are saying they can't even bring it to the floor for a vote because California Democrats have some concerns with the overarching bill. And so even on something that has as much agreement about antitrust in big tech, you are seeing Congress really get stuck in the details here. And it's not even necessarily a partisan thing.
I mean, to me, it's an end around politics, whether the president's Trump or Biden. I'll let somebody else decide that for me. Emily, I'm looking at grass-fed beef. I mean, you know, the fact is, I'm going to go out to Ben's Chili Bowl up on U Street in Washington this weekend, and I know they're going to use grass-fed beef, and it's American-made, except this document says much of it is not. So they're going to micro-tune the Department of Agriculture to what? Pull it back from Trump things or to make new law, new initiatives?
I mean, a lot of this is a reversal of what we saw with the Trump administration. I mean, we see that from the FCC's net neutrality rule that Biden is now asking them to look into, to some just regulatory things in general, Tom, as you just mentioned. And please enjoy a chili dog for me while you're there.
Yes.
But a lot of this it is a reversal from the Trump administration. And it is, to a certain extent, Biden's going to be able to do this very quickly. He's able to send out a message. But at the same point, the fact that he's doing this via an executive order means that it's going to be very easy for the next president, if they're a Republican, to quickly undo a number of these things.
Emily Wilkins, down in D.C. It's good to catch up. Emily, thank you. For anyone that thinks Tom goes off on a tangent and you don't know where he's going, and I know some people wonder whether we actually get on. We do. I remember going for lunch with a former central banker. I won't name the central banker. And we talked about Tom's interview style with central bankers. And he said, here's the thing, John. When he mentions these random studies and these random things, they're real. And they are actually appropriate for the conversation we're having. And when Tom mentions beef, the first thing I would do is just go to the particular statement from the White House this morning and search for the word beef. And here we go. So let me add some meat to the bones of what you're talking about, Tom.
Cute.
4 large meat packing companies dominate over 80% of the beef market, and over the last 5 years, farmers' share of the price of beef has dropped by more than a quarter, from 51.5% to 37.3%, while the price of beef has risen. Tom, that's just a little example of the things they're trying to get at in this economy.
It's a stunning document, I really have to say. It is a compendium, John, of what maybe under President Trump would have been 15 executive orders, all in one, all laid out with immense precision. And as you say, John, paragraph to paragraph, immense anecdote.
That is just one anecdote, but the broader story is clear. That leads to that one anecdote, remain as consolidation, and they're not a big fan of it.
Not a big fan of it at all. They basically make the case here that it has had not only harmed consumers, but you see in this document, he talks a lot about how it's potentially harmed workers. The idea of people being able to switch jobs and facing non-compete agreements or facing issues with the mobility of their licenses from one state to the next. The idea of more right to organize rules. It'll be interesting to see whether what the follow-through is here, and more importantly, what kind of pushback you get. A little bit harder to lobby regulation versus legislation, but I'm sure some of these industries are going to push back and push back hard.
John, are they going to legislate Amazon Prime?
It's over.
You know,
it's over. Like the growth scare remaining from this morning as well. Look, TK, we have to talk about the labour market and all of this as well. I mentioned the late, great Alan Kruger.
Yes.
Danny Blanchflower of Dartmouth has done some great work on this as well. I understand from our producers that Danny can join us in about 20 minutes' time, so that would be absolutely
They didn't tell me that.
Fantastic. I usually get first word on these things, Tom.
Really, you do?
Coming up in the next hour, 8 a.m. Eastern Time, David Riley of Blue Bay Asset Management from New York City this morning. Good morning. Really interesting morning. 43.29 on the S&P, advancing 16 or 17 points, up 0.4%. Outside of that, Treasury's lower yields higher by about 5 basis points to 134.11. Heard on radio, seen on TV. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Romain Bostic. Lisa Abramowicz back with us on Monday. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden is signing a wide-ranging executive order today aimed at promoting competition in the economy. Amongst other things, it calls for supporting programs that would import cheaper prescription drugs from Canada, save consumers money on their internet bills, and make it easier for people to get refunds from airlines. The president also seeks greater scrutiny of mergers in the tech industry. And the Biden administration will reportedly add at least 10 Chinese entities to its economic blacklist. That's according to Reuters, and that could happen today. The move has to do with China's alleged human rights abuses and high-tech surveillance in Xinjiang, the homeland of Muslim ethnic Uyghurs. China's pushed back strongly against the criticism. It says the U.S. and its allies are bullies. And Pfizer plans to request U.S. emergency authorization for a third booster dose of its COVID vaccine. That's after data showed it can sharply increase immune protection against the coronavirus. Still, federal health officials signal that they would take a cautious approach to potential booster shots. And a new twist in the assassination of Haiti's president. Colombia says retired members of its army are suspected of having taken part in the killing. Haitian police said 28 people carried out the attack against the president. 26 of them are said to be Colombian. The other 2 were described as U.S. citizens of Haitian descent. 4 alleged assassins have been killed and 6 others arrested. And billionaire Richard Branson has made his reputation with a series of daredevil exploits. He returns to that on Sunday when the 70-year-old is scheduled to take a rocket-powered trip to the edge of space. A test flight of Branson's Virgin Galactic craft would be a step towards carrying ticket-buying passengers. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Let's be very clear. For France, we aim at having more than 15% for the minimum taxation. I think that we need to be ambitious. This is the unique opportunity that we have to have a fairer, more efficient international taxation system for the 21st century.
It is fair to say that Maria Tadeo did not get the short straw. Maria Tadeo with Bruno Le Maire, the French finance minister, speaking at the G20 Finance Ministers Conference. Where are they, Tom?
They're on the east side of Venice at
Yes.
Arsenal, which is incredibly historic, and to visit is jaw-dropping. It's where, John, they built all the stuff to battle the Genoese over in western Italy, out in the Adriatic, and then over to Turkey.
And you're very unhappy that you're not there, I'm sure.
And even worse, I'm told Francine Lacroix is leaving today to follow up with him.
Oh, really?
Because, John, I mean,
that's not a
for
shock.
starters, Ferro, Italian.
I know.
Like, if anybody should go, it should be you and Francine.
Tom, you and I could have gone. We could have watched the game on Sunday.
You know,
could have done a
hung
little
out at the
thing
bar,
on the
the
recovery of the
Metropole,
Italian
you know.
economy.
I mean, the Metropole's halfway to Arsenal from the fancy hotels,
Would
and the
it make
Metropole's
sense?
where I stay.
Tom Keene, Jonathan Ferro, alongside this morning, Romain Bostic,
Romain's
Lisa
going,
Abramowicz
"What
back
are they
with us on
talking about?"
Monday. Sometimes we do this, Romain. I think he's
Yeah.
familiar already. S&P 500 futures up almost 18 points on the S&P, 43.31. Let's call it 43.31 on the S&P 500. We advanced 0.4%. Tom, yields are higher by 4 or 5 basis points. Your yield on a 10-year this morning, 134.11.
Yeah, it's come back. I mean, it's just a better tape. That's all there is to it. Just plain and simple. Just any
Nasdaq basically unchanged. There you go. Nasdaq 100 futures unchanged on the day now too.
We need to get ready for next week. We're going to do that with James Paulson. Jim Paulson with Luthold Group, their chief investment strategist. A quick visit here. Jim, how important is this earnings season?
I think it's going to be important, Tom. I mean, this market's facing a lot of negative things right now. Everything from being up almost 100% off its March 2020 lows. That's one of the biggest 15-month advances in the stock market ever in post-war history. You got COVID variant up, scaring people. You got inflation surging here. You got Fed talking tapering. You got the M2 money supply contracting. You got the stock market wondering what the bond market knows that stock investors don't. So there's a lot of negative pressure. And one of the things that could alleviate that would be another earnings season, which is going to probably be phenomenal again. And what is really going to be important, I think, is not even so much the raw numbers, although they'll help, will be if some of the CEOs still have confident outlooks for the future. I think they'll take the sting out of some of this and maybe start re-rallying the stock market again.
Jim, can we just get into that Wall Street cliche that you just used tongue-in-cheek just a moment ago? This idea that there's this room of bond investors doing their own thing and they don't talk to the stocks investors, and the equity investors sit in another room and they look over and say, what do they know that we don't? Do we really think that way when we see a move in the bond market, that someone knows something we don't?
Well, I think we've kind of come to get used to that, because certainly the bond market's got a heck of a good record, Jonathan. I've been burned by it in the past, where the bond market's doing something and stocks aren't, and the bond market ends up being right. So it does gather your attention. I think there's, special factors today with quantitative easing being such a heavy influence in bond yields. But I got to tell you, I look back historically, and we've got an interesting situation going on here where yields have been falling in the last, long-term yields have been falling in the last several months. And yet, when you think forward over the next 6 months, almost everything fundamental is going to go up. Yeah. Real GDP, jobs, incomes, profits, and almost everyone thinks that, and it's probably correct. Not only will it go up, it'll go up strongly. And when you have this combination historically, going back to 1950, of falling yields for several months, followed by fundamental improvements, that's been really good for stocks. In fact, since 1990, the stock return in the next 6 months, after a falling yield period like this, has been nearly double the return of all the rest of the time. So I'm not as concerned. I think before the stock market really finally gives way, we're going to have to see higher yields. I'd be much more concerned if the bond market's at 2%, worrying about inflation, than I am about at 130 worried about weak growth, because I don't think we got weak growth coming.
All right, so a lot of cues we can take here, Jim, from what's going on in the bond market for equity investors. I'm curious, how much attention do you have at all right now on what's been happening with the dollar here? That seemed to be the call a lot of people were making. I don't know, I felt like 8-9 months ago, sort of watch the dollar, watch the dollar. I'm not sure what the dollar has really told us just yet.
Well, I think, Romaine, that the dollar has got a very similar message to the bond market. The dollar rally that we've seen, which has been fairly significant, had occurred almost coincidentally with the drop in bond yields. And I think they're both saying the same thing. There's a bit of a fear premium here. The rush to the dollar, I think, is rush to safety, if you will, which kind of reflects the same thing going on in the bond market. I don't know if they're right, but they seem to have a very consistent message. And of course, the dollar rising certainly hurts the cyclical sectors, it hurts international stocks, it hurts small caps more. And I think that it helps people return to growth stocks. It's been part and parcel of the shift in leadership that we've seen as well. I personally think the dollar is going to come back down here in the rest of this year, and yields are going to go back up.
Jim, I'll give you a choice. NASDAQ 100 for the rest of this year, or SPX, the S&P? What do you hold? Which one? NASDAQ 100 or S&P? Or the Russell if you want. You can have the Russell if you want to. There's 3 choices there, Jim.
I like the Russell. That's the one I'd go with. I'd go small cap stocks.
I had a feeling you might. That's why I gave you the option. Stocks. I'm feeling nice, Jim. It's good to catch up. Jim Paulson, the Luthold Group Chief Investment Strategist. Just that simple question gives you an idea, Tom, of where people still stand on the equity market and which part of the equity market they like. The small caps for Jim Paulson.
And to me, John, it masks the big issue, which is you've got to be in the market. Take Gina Martin-Adams of Bloomberg Intelligence with the mantra, look, you've got to be in the market. How many people, John, aren't in this market?
And that's the problem. And how many people are worrying about being active when being passive year to date remain? Yeah, you've done okay in the NASDAQ and the S&P and the equal weight, the Russell. Take your pick.
Yeah, and I mean, you look at this morning, you look at futures this morning, it is Russell futures out front of pretty much everything else. And there was a lot of people saying that people were too quick to turn their back on some of the cyclical names, some of those small cap names, that maybe that was a little bit too premature. Maybe that bid comes back in, maybe it's sustained, maybe that brings us back up to the levels that we were just at, I guess, Will, a week ago.
The bond market in the driving seat, yields set the tone, and yields this morning are higher, so take that and guess what's happening elsewhere, and you'll probably be right. Another thing we've got to do in the next 30 minutes of this particular hour is get up to speed on that executive order from this White House, Tom. And I mentioned a little bit earlier we'd catch up with a labour market expert, one of the best worldwide, and we will do that with Danny Blanchflower at Dartmouth next on this program.
His book, The Wage Curve, was definitive when it was published. And what's so cool about Professor Blanchflower, John, is he has continued his research. He has been extremely productive in the last 24 months.
Danny Blanchflower of Dartmouth joining us on this program next on radio, on TV, alongside Tom Keene. I'm Jonathan Ferro. Together this morning with Romaine Bostick. Your equity market, 43.30 on the S&P, advancing 18 points. We advanced 0.4%. Bonds set the tone. What does the bond market know that you don't this morning? Yields are higher by 5 basis points, 133.94. From New York, this is Bloomberg. Live from New York City for our audience worldwide on TV and radio. Good morning to you. This Friday morning, here's the price action. S&P 500 futures doing okay, approaching 43.30. We advance about 0.4%. Nasdaq unchanged, totally flat at the moment. Your clue, it comes from the bond market, as you might expect. Off the back of these moves, we've seen 8 straight days coming into Friday of yields lower, and banks have been hurting. The banks from the June highs down about 11% on the S&P 500 banks. Can they get just a little bit of reward from this bond market now with yields up and a curve a bit steeper? 133.77 on 10s, on 30s, 197.18. We advanced there about 4 or 5 basis points. Still sub 2% though. I want to look at the curve. Here we go. This is 530s. And I want to acknowledge where some of the thinking that I'm going to at least explain to you right now is coming from. Ed Bradford out on Twitter with a wonderful chart of 530s. And it's the second peak that you'll see in the year of 2021 that is fascinating. That second peak came on May 13th. May 13th for the peak in the yield curve. May 13th. Now, that's important, Tom, because that was a single day after the April CPI report. That steepness in the curve, and since we got that, this curve's rolled over. It's been flatter. So really, when you start talking about peak everything, it's peak inflation fears that are important here. And when it comes to the curve, something else, some work that our colleagues Liz McCormick and Elizabeth Stanton did on Bloomberg News in the last 24 hours. Take a look at their piece about the yield curve and what some of the people on Wall Street are saying about it. So here's the stat for you, Tom. Citi did the work. They looked back pre-2008 when the yield curve peaked, on average, 12 months before the first rate hike. So just think about it for a moment. Have we already seen the peak of the yield curve in America? Which is kind of difficult to get your head around because this cycle is moving so quickly.
I agree. To get your head around it in July is really difficult. I think John will have so much more clarity after earnings season and after some of the hard data comes in onto the not only the next Fed meeting, but the next 2 or 3 Fed meetings as well.
This chart right here, 5s, 10s, but 530s says the same thing. So take a look on your Bloomberg terminal. Let's get you some movers. Here's Romain.
Yeah, John, let's start off here, of course, with the Biden administration set to sign this executive order, pretty sweeping executive order seeking to target competition out there across a wide variety of industries. The market reaction so far, though, has been relatively muted. You can see Facebook down about 0.2%. Comcast, which, of course, would be affected by some of the net neutrality rules that the Biden administration is seeking to revive. Those shares only down about 0.2%. And the railroads actually slightly higher, though we should point out the railroads actually had sold off yesterday because of concern about this executive order, which, of course, is also going to target some of the shipping costs as well. It'll be interesting to see how much saber rattling the Biden administration does, but more importantly, how much follow-through there is, because we've been here before, even with previous administrations, concerned about consolidation, concerned about competition, but ultimately not a whole lot came out of it. You flip up the board, the other big story here that we're going to be talking about, particularly heading into next week, of course, is the start of the earnings season. The big banks, of course, kicked that off, including Bank of America, Wells Fargo, JP Morgan, and the like. Those stocks getting a little bit of a bid today. That might partly be because of what we're seeing in the yield space, but also relatively high expectations here going into that earnings season. And keep an eye on GM. Dan Ives out with an interesting note this morning. Of course, he's been relatively bullish on Tesla for a while and its EV strategy. Now, he's bullish on GM and its EV strategy, initiating coverage there, really saying that GM now, one of those companies that not only is is managing to catch up with Tesla, but more importantly has the potential, guys, to actually get out in front of it.
Romain, thank you so much. From the advent of Bloomberg on the economy and Bloomberg surveillance, what we've tried to do is go to the experts. That's been the demand of all of our audiences, and particularly global Wall Street. David Blanchflower, a few decades ago, definitively restructured our labor thinking with his book, The Wage Curve. And what we all know is our wage curve as a society has been shattered in the recent decades. He is at Dartmouth College. David Blanchflower joins us this morning. Danny, I look at where we are, and you're the first name that I came up with. And what I want to talk about more than anything is the primal scream nature of the 72-point executive's order. Who is screaming about consolidation in America?
Well, I guess the way you would think of it now is that workers have been hurting. Non-workers have been hurting. They've been hit by a serious pandemic, and it's had a big impact on the world. But this sits on the end of many decades of poor wage growth, and the balance of power between workers and firms has shifted quite considerably compared to where it was. So this is a sort of, I read it, and I've read it very quickly in the last 20 minutes.
Sure.
This is a kind of primal scream to try and redress the balance of power between workers and firms. Now, I think the commentary we just had is important. Market response is very little, because the question is, does it have any teeth? Is it merely wishful thinking? So I read it that this is trying to think about some of the stories about big firms, about Google, about Facebook and so on. But this is a scream in a sense.
But David,
start to think about that balance being checked. Whether it can do that is unclear.
What is so important to me, Professor, is the idea from you or liberals like Paul Krugman or conservatives as well. The late Ed Lazier out at Stanford is the overwhelming theme of that document is technology is here and we are using and adapting to technology every day. Within the economics of monopsony, can we take the deadweight loss of technology and can we put the genie back in the bottle?
Well, probably not. I mean, the teeth is the big story, but I do think that in some sense that I like to think of it this way: firms have the ability to pay higher wages. They've seen no real need to do that, and they haven't shared those wages. And those, in a sense, the profits that they've made. So this is a scream to try and do something about that. I mean, look at real wages. I mean, I've written about it for 30 years. Still, even with the growth that we've seen, real wages today are still below what they were in the 1970s. So this is about trying to think about that coming out of the White House, coming out of C.C. Rouse, who cares about these kinds of questions. The issue is, can you change this balance? There appear to be sensible things there in terms of, let's think about this occupational licensing. Let's think about ways in which we can get prices down. But in a sense, Anno Domini just continues. And in a sense, I read it as, we would like for these things to happen. We would like to try and sort of stop the world from rolling. Yeah. But there's little or nothing in it. I mean, there is going to be a White House Competition Council, but that's true. But
well, Danny, let's talk about that word. And forgive me for jumping in, because I think that word is so important. The knee-jerk reaction from conservatives this morning, I think, would be to say, I'm from the government and I'm here to help. Run. Right. This is a problem. The government wants to set prices, all those kind of things. But I hear competition and the lack thereof. And Tom, I think, rightly mentioned the late, great Alan Kruger and some of the work he did on non-compete clauses and the labour market. And this is about trying to reintroduce competition where there hasn't been enough competition. Can you just sit there? That's your world, the labour market. Something like non-competes and a problem that has caused.
Well, this is about the balance of power. When the balance of power sits with firms, firms can put in occupational licenses, and they differ by state. And in the UK, they can do these things called zero-hour contracts. That's what happens when the bargaining power shifts strongly towards firms. If you can somehow or other redress that, take the occupational licenses away, that increases the powers of workers. That's what this document is about. But the first thing you read it, John, is it doesn't have any teeth. It doesn't have, how are we going to do this? Yeah, you can say, it would be a good idea to lower drug prices. It would be a good idea to let people have refunds. And in some sense, what we'll see, and it's something I've argued about a lot, workers' ability to bargain these things becomes greater as the economy moves towards full employment. And so we're seeing these adjustments going on. And in the last 6 or 7 months, we've seen increasing power of workers trying to trying to deal with the bottlenecks that we see. So I think this is a sort of an opening salvo. Yeah. Alan Kruger's work is really important in that area. Firms can impose rules when their bargaining position is strong. We will see what happens. Yeah. But I just think, This is an opening salvo, it seems to me. But
Professor, when we talk about some of the market forces that have sort of pushed a little bit more, given the workers a little bit more bargaining power here, the idea here that the administration now wants to nudge that even further, not necessarily a surprise, but the idea when you start talking about some of these right-to-work issues and some of these licensing issues here, this is now a major shift if he's able to get it through and able to sort of enforce these things. This would be a major shift in the U.S. economy, in the U.S. labor market.
I think it would be, and there are signs around the world that this shift is underway. 2 examples: in the UK, we've seen rising unionization rates, and actually in the United States, in the last data that we have, union density rates, that's the proportion of workers in union, has actually risen. And why is that? It's because actually in the last years or so, non-union jobs have actually declined. So I think there is some evidence in the last couple of years that there is a move away. I mean, the right to work laws are laws that can be imposed when there's plenty of workers around. So I think you're right. The balance between workers and firms seems to be changing a bit. I mean, this is a really important and interesting document. It suggests that, you know, we're going to see a push on the front of let's increase the power of workers. But whether you can impose that is another thing.
The problem is, Danny, that's the left-wing interpretation of this. And I mentioned a little bit earlier what the conservative criticism would be. We're trying to reduce the friction of corporations. Yes. At the same time, I don't want to introduce more friction on the Labour side with unions. And you know that's a political point.
Of course I know that's a political point. That's true. I'm just suggesting that there are trends that are moving, partly because that's what's happening out there in the world. Yeah. I mean, we've seen those things happening. But yeah, John, I mean, I don't think it's the left-wing view. I think it's that the reality is where we are. How that's going to change will really depend upon how tight the labour market is.
Yeah, and we can both agree we need more competition. Danny, you and I could talk forever. I'll give you a call later. We'll carry this on and a little bit more. Danny Blanchflower of Dartmouth College. Thank you, sir. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Romain Bostic. Lisa Abramowicz will be back with us on Monday. Equity futures 43.30 on the S&P, advancing 0.4%. Yields are higher by 5 basis points to 134.44. I think we can all agree we need a bit more competition. It's just how you achieve it. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden's team is concerned that time is running out to revive the Iran nuclear deal that Donald Trump abandoned. There have been 6 rounds of negotiations in Vienna, and there's little sign of when a 7th might start. The stalemate is compounded by Iran's technological advances and the election of a new hardline president. A new British study says that most young people face an extremely low risk of illness and death from COVID and have no need to shield from the virus. That backs up clinical reports that children and teens are less likely to be hospitalized or face severe effects. The US is actually one of the few countries that offer the COVID vaccines to children ages 12 and over. European finance chiefs are trying to reassure their group of 20 counterparts that the region will unite behind that global corporate tax deal. Bloomberg spoke to Spain's economy minister in Venice.
I'm quite confident. I think that a lot of work has been put into this negotiation. There was a major breakthrough with the new administration on the other side of the Atlantic, obviously. And I'm confident that we will have a deal that sets the basis, for the appropriate legislation throughout the world.
Calvino is also confident there will be a deal on the taxation of digital giants. The US wants existing taxes on those companies removed. China is trying to make it easier for banks to go lend to smaller businesses. The central bank has cut the amount of cash that it must hold in reserve. The People's Bank of China cut that reserve ratio by 0.5 percentage point for most banks. That should free up about $154 billion into the economy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Governing Council considers that price stability is best maintained by aiming for a 2% inflation target over the medium term. The new formulation removes any possible ambiguity and resolutely conveys that 2% is not a ceiling.
That was President Christine Lagarde of the ECB. This whole strategic review, I think, tells you so much about Europe, Tom. All that effort, all that time dedicated to making the smallest of possibly inconsequential moves at the European Central Bank.
Folks, I'm worried more about Italy, England. I didn't see that video until just now. John, you've got to be kidding me.
What do you want me to say? I think the bond market heard what you heard, Tom, which was not a lot from the ECB.
Wow.
Do you think that's Christine Lagarde, the ECB president, or do you think that's just the natural consequence of the construct of the European Central Bank and the Bundesbank's role in all of this as we go on?
Look, I have a hallway, John. My eyes are so bad I don't read books anymore, but I got a hallway left of economic textbooks I've collected over the years. None of what we're living is in one single of those books. They're all making it up as they go. Somebody who makes it up, and we read each and every day, is Ian Lingen, BMO Capital Markets. He writes a brilliant morning note giving guidance on price and yield. We're thrilled he could join us in this tumult today. Futures up 22 right now and yields higher. Ian, what are you writing today so I can think about it over the weekend to act on Monday? What is the specific thing for this weekend?
So for this weekend, Tom, I think that the primary focus should be preparing for next week's accelerated auction schedule, as well as CPI on Tuesday. What we have is, because of the settlement issues, we're going to have a 10-year reopening on a Monday. It's very, very rare. And I suspect that that's what's going to drive price action in the very near term. So we've been on board with the rally back to 125, but from here, a period of consolidation makes sense as the market comes to grips with the reality that this is a big repricing that has taken away from the reflationary notion.
There is, in the equity market, Ian, I think you're aware there are stocks out there that you can go long and short on. There's BTFD. How about BTDD, buy the disinflation dip? Are we seeing bond people come in here with the yield movement and act?
For sure. I think what we're seeing is people looking at a Fed that we thought would be less responsive to inflation, not dissimilar from what the ECB is now signaling, to a Fed that's they'll step up if needed. And I think that that's where we have seen a flattening emerge. And that does suggest that any type of near-term inflation that we see, if it isn't transitory, the Fed will get involved. And if the Fed gets involved, that is, by definition, the anti-reflationary trade.
You mentioned the supply next week, 3s and 10s, 30s as well. Get a lot of supply from the Treasury next week. You've made the point, though, Ian, you mentioned CPI out on Tuesday. You've made the point repeatedly that you should ignore the data. Do you think you can still ignore the economic data?
I think that we should be ignoring the traditional reaction function to the data. So said differently, higher inflation, we might want to sell treasuries. I would say buy them in this.
Wow, interesting. Carry on. Carry on, Ian.
Well, the notion is anything that brings the Fed's liftoff rate hike closer is going to be bad for 2s, 3s, and 5s. But because of the flattening dynamic that has emerged, it's going to be good for 10s and 30s. So a big counterintuitive response, but I think that that is what the market has been telling us over the course of the last 2 weeks.
Ian, that is not early cycle behavior, is it? That's what you'd expect towards the end of a cycle, am I right?
Exactly. And I think that that's the same argument as we might be experiencing a bit of a policy error on the side of the Fed. That's not our stance, but that narrative is out there as well. And that's just the idea that the Fed's taking the excessive monetary policy accommodation away a little too quickly. This makes sense given what we're seeing from the global recovery perspective, as well as the risks associated with the Delta variant.
So when we start talking about some of the spreads and the narrowing that we've seen, where's the equilibrium that you're looking for right now, Ian?
So at this moment, I still think that there's a chance 10-year yields can make it to 121, 122, but that will represent the local bottom of the yield range, and that won't occur for at least a few more weeks. What a dynamic equilibrium in the 10-year market would look like would be something closer to 135 to 140, after we take down the auction, but before we try to trade the CPI numbers. And it's really the reaction to the CPI that I think will help recalibrate the market's expectations into the balance of the summer.
Yeah, I think the reaction to those two data points next week, both the CPI and even to a certain extent the producer prices. I am curious about the auctions themselves here and the participation that we might see here. With regards to foreign participation here, is that really what's going to drive it next week, or are we going to see a little bit more coming from the domestic dealers?
Well, there has been a lot of price action that has occurred during the overnight session. So some of the extreme lows that we've seen in Treasury yields have occurred early in the morning during the overnight session. So that does speak to the importance of foreign participation at the auctions. However, I will argue that given the trend that we've seen in auction participation, there is plenty of domestic demand to take down treasuries. And recall, we're about to reach an inflection point at the end of this year, perhaps the beginning of next, where not only have the nominal auction sizes plateaued, but we'll start to see them creep a little bit lower, and supply will become even less of a concern.
Ian, just quickly, new range on 10s. What is it?
4 decimal points.
For the next month and a half, I will call it 121 to 147.
It's a fat range for the next month and a half. We'll take it, though. Ian, thank you.
That is great.
Ian Lingen of BMO Capital
That was
Markets.
just, folks, that was just a window into the real world of institutional bond management.
Ian's fantastic, one of the sharpest on the street, Tom. So we talk about that new reaction function. I think it's important. The traditional reaction function to the economic data for this market, typically upside surprise on inflation, yields higher, curve steeper. Ian making the point that maybe it's different. Maybe it's different now, and that maybe it's that later cycle dynamic you might expect, where higher inflation prints would lead to a more reactive Federal Reserve, and therefore it's a buy on 10s. It's a buy on 30s.
It's a market call, John. You know, I'm not in the business of market calling here, and I do take the point of everyone in equities at the bond market now is leading the way. But I'm just going to say it, John. I believe in the resiliency. These corporations are going to adapt. Are we going to get through this ginormous trillions of fiscal debt? You know, the reaction functions are a mystery.
We'll hear from the corporations next week. Tuesday morning, JP Morgan kicking off earnings season stateside from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Romain Bostic this morning. Lisa, back on Monday.
Oh,
That's
she
gonna be
says.
great, isn't it?
Says who?
You think she's going to be longer?
I think she could extend.
Take an extra few days.
Extend and pretend.
On Crete or not on Crete. Equity
no,
futures,
she's not on Crete.
43.35
Maybe
on
Corfu.
the S&P, up 0.5%. Genuinely, she's not on Crete. Yields are higher by 4 or 5 basis points.
Genuinely, I don't think she's on Corfu either, but
to
we can say
134.11. Where is she?
Maybe the Upper West Side.
I don't know. I don't even know. From New York City, on radio, on TV.
I didn't get a postcard, nothing.
I got nothing either. This is Bloomberg.
We're going to have another year or two of above trend growth. And I think that that's going to be something that we should be pretty encouraged about.
Some type of a pullback here just seems natural and normal. And this is not the reason to exit the market.
The market likes higher rates, and people just don't want to buy into that idea.
You got the stock market wondering what the bond market knows, the stock investors don't. So there's a lot of negative pressure.
When eventually rates rise, I think you're going to have a problem there. But for the moment, I think the economic and monetary backdrop is very favorable.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. We welcome all of you. Lisa Abramowicz, off, on a most unusual Friday. It is a growth scare recovery. John Ferro, just moments ago, red and green has become all green. NASDAQ 100 goes positive.
Up 0.1% on the NASDAQ 100, on the S&P advancing 0.5%. Guess where the bond market is? Lower. Yields are higher by 4 or 5 basis points, approaching 134 on 10s. And Tom, you're willing to say this one's over?
Well, I'm not willing to say it's over, but I'm saying
you said it twice 2 hours ago.
Well, a lot of people are saying it was a growth scare.
Okay.
We went through it, and up we go. Ben Laidler really reaffirming that this earnings season will be definitive. What to me is unusual, John, is on a Friday, it's not jobs day. Friday, July. This has been most active. I'm sorry. The 72 points from President Biden on competition in America, every corporate officer will have to address that.
Tom, we are totally on the same page on this. This is not the summer that people expected. You see that reflected in the market. And I think next week for earnings is going to be absolutely fascinating. The divide between the commentary from macro strategists on the bond market and what you'll hear from the C-suite, from the corporate leaders from Tuesday onwards in America could be very, very different.
It will be. Romaine Bostic, fold us into the close and what we're going to see on earnings. And frankly, what we see at Sun Valley, all those elites are going to have to meet to greet to say, how do they adapt across 72 items?
Yeah, 72 items. It'll be interesting to see how many of those items become reality. I think the message, though, is clear that at least for the next 4 years, next 3 years now, 3.5 years now, you have a regulatory environment that's going to be a lot more scrutiny over some of these deals here. And I think that could put a little bit of a chill on some of these mega deals, but overall here, the market seems to be taking it in stride.
John, let's go to the bond market right now and really dive into this. I'm looking at the real yield. We went down to a negative 1 point whatever. We've really come back 7-8 solid basis points here, a more attractive, lesser negative number.
Let's go to the nominal yield, up 4 or 5 basis points on 10s, back through 130 after a break of 125 yesterday. Your yield, 133.77. Futures positive by 0.5%. What's the new range over at BMO? Now, Tom, on a 10-year, the low 120s to 147
I think it was,
for the next month
hilarious.
and a half. Look, what was really interesting about what Ian Lingen had to say is basically, even if I told you what the economic data point was going to be for next week, the week after, could you tell me with confidence and conviction how the market would respond to it? And that's what the story is for me right now. It's not about the economic data alone. It's about how the market will respond to that information. And that's where the critical information is at the moment. And as a belief from Ian Lingen, of BMO and others, Tom, that upside surprises on inflation brings the Federal Reserve in, which means yields are lower, and it's a bullish story for 10s, for 30s. It's a flattener, it's not a steepener.
That debate will continue, and we'll do much more on that next week as we dive into earnings season. The other raging debate, the state of the American economy. Neil Irwin, I should say, over at the New York Times, really emphasizing a study of what GDP is doing as being the foundation study right now for all in the markets. David Riley at Blue Bay Asset Management agrees. He says, grin and bear it, it is a growth economy. David, what does the slowdown gloom crew get wrong?
Well, I think they get wrong the extent of momentum that we have in the US and I think also the global economy right now. And we still do have continuing substantial fiscal support, and I think that we're going to get more going forward as well coming out of Washington. We're getting things like the Recovery Fund will start to be dispersed towards the end of this year and into 2022 within Europe, and of course with the vaccine rollout as well supporting reopening. So I'm pretty confident. I have got a high conviction, even though the market's kind of challenging that conviction in terms of how the bond market's performing, that we do have strong growth for this year. We'll have above trend for growth for next year. I think where the market can reasonably or those with contrary views can reasonably challenge and sort of say, yeah, but once we get past that, then we're going back into a sort of secular stagnation of excess savings, low growth, low inflation, and the Fed will never be able to get rates higher. It's going to end up getting trapped in a way that I think the ECB has done. I'm not as pessimistic as that. So, and I think right now the market is underpricing the Fed. So, I still think that bond yields are going to end meaningfully higher by the end of this year. But I'm taking some pain. I'm having to grin and bear that right now.
David, earlier on, we caught up with BMO, talked about the reaction function of this market, how a market responds to incoming economic data. He made the point it's not what you expect. Might be a little bit more counterintuitive in the future. The upside surprises on CPI will actually lead to lower yields at the long end, 10s, 30s. Are you pushing back against that?
Well, I think in the near term, that is because the market has interpreted the last meeting of the Fed as this, hawkish pivot, and basically decided that the Fed has blinked in terms of its average inflation targeting regime. So if you get higher inflation in the near term, that makes the Fed more likely to hike rates. But as I was saying before, people are sort of now debating this kind of secular stagnation over the medium term. But I think they're wrong on that. Both, I think that as the data comes through, we will see higher and stickier inflation as well as stronger growth. But also, actually, that I don't think the Fed has become meaningfully more hawkish. And so at some point, I do actually expect the curve to steepen back again and to get back onto that more kind of reflationary trade.
Tom and I hate the when questions. When will that happen? But David, I do think it's important. When you think we'll have sufficient information to challenge the current consensus, when do you think that will happen?
I think we're going to be looking at sort of September, October time. I mean, what's important is, in addition to the inflation numbers, is also, of course, what's happening in terms of the labour market. And although we had a pretty strong payrolls headline number, the actual unemployment rate, somewhat surprisingly, ticked up. Now, our own forecast suggests that unemployment is going to be approaching 4% by the end of this year. So I think, when we get to sort of October, we'd have had a number of payroll reports, including, the September payrolls, which will start to reflect some of the runoff in terms of the extended unemployment insurance, kids returning to school, mums getting more access to the labour market as well. So some of those sort of labour supply constraints may start to dissipate as well.
So, David, as we sort of try to assess this growth story, this growth scare, whatever we want to sort of call it here, can you maybe walk us through the divergence that we've seen lately between what's been going on with regards to sovereign debt and what's been going on with regards to corporate credit? Because they seem to now be uncoupling maybe just a little bit.
Yeah, I think it's a good point. That, I mean, one aspect of what we've been seeing of late is that while, we've seen the volatility in the rates market, we've seen the equity market starting to respond to that and thinking, the bond market is telling us that, growth is slowing and potentially meaningful. Credit's actually held up pretty well. Now, in part, credit doesn't need sort of really strong growth and corporate earnings growth in order to be still a relatively attractive from a carry perspective. But I do think also the credit market right now is sort of saying, well, maybe growth is maybe moderating, but that's it's not waving any kind of red or even amber flags, in my opinion.
David, my observation is you're not focused. I mean, that's all I can see now. John, this is just simple. Riley is focused on one thing, and it's what England is going to do against Italy. Let's get to it. How do they do this, John Ferro and David Riley? Does England have to come out strong? It's the when question right now. When does England do it? Do they come out strong in the first half, John, or do they have to be patient and come out strong in the second half?
I think a lot of it comes down to one player for England. David, I'm sure you agree. Raheem Sterling has just been a standout performer. Player of the tournament for England. If he turns up, there could be a bit of trouble for Italy. He's just been absolutely fantastic.
Yeah, I actually think Italy overall are the actual better team, but England do have home advantage. So I am hopeful that will be enough to kind of get us over the line. But as Jonathan said, I mean, Raheem Sterling running at the Italian centre-backs, I think, could cause them some problems, particularly if they touch him.
And of course, which Italy turns up? The one against Belgium or the one against Austria? I'm more interested in London.
They won 33 matches in a row, John.
Unbeaten 30-plus games. The City of London, Tom, Monday morning. How does that work, David? What have you said to your team? Are you turning around to them and saying, look, I don't expect you to be in early on Monday morning after the big game? What are the expectations from the staff in the City?
Well, I've told them don't expect me to be in.
Oh, you've told them that. What about them, David?
No, they've got to be bang in there. Right? I mean, someone's got to work. I mean, don't forget, I'm a lot older, so I've got to sleep. Free time. I do need my sleep. So, I mean, hopefully, we won't. There'll be a little bit of positivity and euphoria. Maybe a sort of cheeky long Sterling trade.
We should send a camera out to Bank Station, just outside of Bank Station, Tom. On Monday morning. I'm telling you, tumbleweed all the way through to lunchtime.
It's called bunk, right?
Bunk.
Bunk. Yeah. What I noticed here is David Riley just, he was not focused until we brought this up, John, and he's just full on right now.
I would agree. David, in the zone. David Riley of Blue Bay Asset Management,
thank you.
Chief Investment Strategist. TK, Monday morning, it's going to be dead. I'm telling you.
I-
No one's
You
turning
know, it's
up.
one, I mean, even the prime minister, and you saw at the end of the game the other day, Prince William clapping as well. John, let me ask: does the Queen show up?
I don't think the Queen is showing up. I imagine Prince William attends the game again.
I mean, it's like a
I
huge.
would expect Prince William to be there. First major final since 1966, Tom. It's been a while for the England national team. It's a big moment for the country.
How did they get here?
They had a favourable draw. Okay, 2 points on, mate. One, they had a favourable side of the bracket. But the second point I would make is that unlike the previous England teams, which, to be honest with you, I detested because of the attitude of some of the players,
right?
This team's really quite likeable, Tom. It really is. This England side
Unlike Bloomberg Surveillance.
is really quite likeable, like this team too.
Yeah, it's quite likable.
With the exception of you and I, 43-34 on the S&P, up about 0.5% from New York City.
Oh, Lisa, come home.
For our audience worldwide, Guy Johnson writes in, it's dead on Monday anyway. Everyone works Tuesday, Wednesday, Thursday. The new way of things in the city. Thank you, Guy. Guy Johnson coming to you in about 2 hours' time. From New York City, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden is signing a wide-ranging executive order today aimed at promoting competition in the economy. Amongst other things, it calls for supporting programs that would import cheaper prescription drugs from Canada, save consumers money on their internet bills, and make it easier for people to get refunds from airlines. The president also seeks greater scrutiny of mergers within the tech industry. The largest business and labor organizations in the U.S. are joining forces to push for the $579 billion infrastructure bill. The Chamber of Commerce and AFL-CIO are on board, along with groups representing manufacturers, retailers, and builders. President Biden and a bipartisan group of senators brokered that agreement last month. And billionaire Richard Branson made his reputation with a series of daredevil exploits. He returns to that on Sunday when the 70-year-old is scheduled to take a rocket-powered trip to the edge of space. The test flight of Branson's Virgin Galactic craft would be a step towards carrying ticket-buying passengers. And Bloomberg will have complete coverage of the launch on television, radio, and Quick Take this Sunday, starting at 9 a.m. Eastern. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
From New York City for our audience worldwide, live on TV and radio, this is Bloomberg Surveillance alongside Tom Keene. I'm Jonathan Ferro. Together this morning with Romain Bostic. Lisa Abramowicz is back with us on Monday, and here's the price action. This Friday morning, equity futures are positive 21. We advance 0.5% on the S&P. The Nasdaq 100, that's advancing 18 points, up by 0.12%. Outside of that, we're taking our cue once again from a bond market that's seen 8 straight days of yields lower. Today, yields higher. 4 basis points to 133.60. And Tom, just quickly, briefly, in the interest of balance, after all that so-called soccer talk, someone writes in, no idea what the percentage of your audience is American, but those of my generation have 0 degree of interest in soccer. Game using head to strike a ball is just dumb. So, you know, just putting that out there for the other people out there.
Did Romain send that in? Romain, did you send that in?
I didn't know
Was
you were
that
gonna
you,
read it
Romain?
on the air.
Is that your ghost account on Twitter? I understand people feel like that, Tom, on that particular sport.
I am in Romain's camp, but I do enjoy watching.
You're trying.
it.
I know. I feel like we've converted
distinction-
you. I think we have.
John, the big distinction here is Americans were foisted subpar soccer. And when we see world-class soccer, we're like, oh,
Don't you
that's
think
really interesting.
if we had the World Cup here tomorrow, that it would be massive in this country? I think it would. I think it would be huge. Be nothing like '94, where there was very little interest in the game, Tom.
Yeah.
I think if it was held now, it would be huge.
Dr. Dudley's going, what are they talking
Dr. Dudley would be
about?
buying tickets for those games, Tom. You know he would.
Joining us now, William Dudley. He is of Berkeley. He is of Goldman Sachs and, of course, the former president of the New York Federal Reserve. And we're thrilled he could join us. And he writes presciently on labor this morning. Bill, I don't want to go into the details of President Biden's 72 points on the power of corporations and the consolidation of corporations and the weakness of labor. You do address it this morning in your note, but I want to go back to an important article you wrote 6 years ago. What kind of jobs have been created? Bill Dudley, how did we get here with declining labor share?
It's not really clear exactly why labor share has declined so much over the last couple decades. Presumably it's because corporations have more power. Antitrust policy has been less aggressive in dealing with anti-competitive practices, and I think labor's power from a unionization perspective is also lessened. But it's also a question of how tight is the labor market. Through much of the last economic expansion, there was an excess supply of labor. We only got close to full employment at the very end of the last economic expansion, then the pandemic hit. So I think the key is going to be, can the Fed drive the economy to full employment? And if the economy is at full employment, then I would expect labor to do better and pick up a bigger share of income.
The primal scream of this document and the political energy that supports it, that supports President Biden, seems to be about a blanket of technology over this generation. Do we underestimate the technological effects on our labor economy, on our American economy?
Well, I think there's no question that the digitalization of the U.S. economy has had pretty powerful effects on the return on capital and the return on labor. I think the ability of people to search now through the labor market and find people to employ is vastly different than it was, when people used help wanted advertising to attract workers to employ them.
Bill, there's some belief that maybe Labour has started to get a little bit more power as we work through this reopening. You've written today in your column, is the labour market too loose or is it tight? Is it loose or tight? And Bill, your answer is both. Can you walk me through the thinking, Bill, in your latest piece?
So it's loose in the sense, if you look at the unemployment rate's still elevated compared to where we were in February 2020 when the unemployment rate was 3.5%. Right now it's 5.9%. It's loose when you look at the number of people who are actually employed. We're 7 million jobs short of where we were in February 2020. But if you look at it in terms of how many job openings there are, the number of job openings is at an all-time record. We have 9.2 million of open jobs. Businesses have a lot of jobs to fill. They can't find workers. You actually hear about that anecdotally in the Federal Reserve's Beige Book report, where they talk about how businesses literally can't find workers to hire to do their work. And some businesses actually are cutting back their hours of operation because they can't find enough workers to keep their output up.
So, Bill, when we talk about, though, the power of workers here, when you go back decades prior, there was an argument to be made here that it was the mobility of workers that also gave them a lot of power, and that with the consolidation of industries, with the decline of labor unions, that sort of leverage is just not there the way it used to be. Is it possible to bring that back? Is it possible for that to be done at the behest of government policy?
I think it'll be difficult because mobility has declined. The willingness of people to move from one geographic location in the U.S. to another is much lower today than it was 20, 30 years ago. And part of that's the aging of the population. As people are older, they're more attached to where they've lived historically. So I think it's really about the Fed. It's really about the Fed getting the economy to full employment. If the Fed can get the economy to full employment, make the labor market truly tight, then workers will have to, businesses will have to pay up for workers, and workers will get a bigger share of the pie.
Bill, let's talk about the Fed just briefly. You've talked a lot about the risk, the balance of risks around a Federal Reserve, that once they do lift off, that trajectory won't be as shallow as the trajectory we saw in the previous cycle, a Fed that you were a part of. Do you still feel that way?
Yeah, because they basically said that we're not going to even begin to raise short-term rates until three conditions are met. The economy has to be, at their view, of full employment. We have to hit 2% inflation, and they have to be confident that inflation is going to go above 2% in the future. That's very, very late to actually begin the tightening process in terms of lifting off in terms of short-term interest rates. Before, they used to try to hit, they lifted off early with the idea of hitting 2% inflation, full employment, and a neutral federal funds rate all at the same time. We're not going to do that this time.
Bill Dudley, important final point. And Bill, good to hear from you, as always. That piece is out on the Bloomberg terminal this morning and on Bloomberg.com. Is the labour market loose or tight? The answer, it's both. By Bill Dudley, the former Federal Reserve Bank of New York president. Tom.
John Ferro, it goes back to two Americas. I remember the clearest, I believe it was John Edwards standing on a Louisiana subdivision lawn where he did a political event and he started talking about two Americas. That's accentuated, I think, of Jeffrey Sachs, who was way out front on the challenges to labor in America. In this document this morning, as Blanche Flower of Dartmouth said, it's just there, it's policy. Does it have any power? Does it have any strength? It is a marching call for corporations to respond. Every single one of those items, John, they are going to have to respond to it.
The emphasis is clear, and I think the emphasis is worth pointing out. Romain, this is about competition.
It is.
I think it's something we all want to see.
Yeah, and I think at some point, it would just to Tom's point too. I mean, if you're a major corporation looking to tie up with another major corporation, the question is, does this maybe give you second thoughts about this, or do you sort of move forward with it and try to test this new policy and test this administration on what it thinks are anti-competitive practices?
We are going to talk to Terry Haynes of Pangea Policy about this particular release in the last couple of hours. From New York City, we'll head down to Washington, D.C. next. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Romain Bostic. I believe Lisa is back on Monday. And Romain can get some sleep maybe next week. Romain, would that be nice?
Yeah, absolutely.
A little rest, a lie-in. 43.34 on the S&P, up a 0.5% We don't eat breakfast on this program. Do you go to the gym?
Yeah,
do you?
I used to before I started doing this show.
This is
You
Bloomberg.
didn't ask me.
From New York City for our audience worldwide, live on TV and radio, good morning to you all. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Romain Bostic. Lisa will be back with us on Monday. Here is your price action right now in the equity market, up 0.5% on the S&P 500. We advanced 21 points. Outside of that, we're taking our cues all week from what happens in a bond market. Yields higher by around about 3 or 4 basis points to 133.27. We need to head down to Washington, D.C. and catch up with our Washington correspondent, Anne-Marie Hordern, this morning. Anne-Marie, this administration very, very focused this morning on competition, competition, competition.
Yeah, and it's all across a plethora, Jonathan, of industries: agriculture, banking, shipping, internet. What's so distinctive of this executive order, it's very much similar to that from the Obama administration, but under the Obama administration, it was in 2016, the end of his administration, and a lot of the things that were in that executive order have since been rolled back under former President Trump. Now, this executive order is targeting a number of industries. Big tech, one of the biggest. And what's so interesting about big tech is that this could probably have bipartisan support. It's, of course, going to agencies and regulators, but potentially we can also see Congress look at some of these executive orders and want to push through some amendments as well in terms of legislation. We already see House Republicans looking at taking on big tech, especially when it comes to censorship. And then as well, pharmaceuticals. That's another big one. I mentioned that because yesterday Speaker Pelosi was talking about very similar legislation that she wants to get through the budget, through reconciliation, when it comes to lowering pharmaceutical companies. But what is very clear is that this administration is not just encouraging it. They are really laying out very poignantly what these what these agencies can do to start fixing some things where they say there's just not enough competition.
Anne-Marie, finally, score Sunday, go.
Forza Italia. I don't know what the score is going to be, but I hope Rome brings it home.
Thank you. Anne-Marie Hordern of Bloomberg down in Washington, D.C. Thank you very much. A lot of people reaching out about this sport on the Bloomberg terminal this morning. Here's the quote. The non-stop play and skill exhibited by top soccer players eclipses the commercial timeout-ridden average NFL game. And I heard a great line on the NFL the other day, Tom, that if they had the same time format as soccer, in inverted comments, you would have a very different physical appearance of football players in the NFL because of the endurance that would be required. The game would be more intense and it would be far more interesting.
John, I sat on the couch, 2 days ago with Denmark, and I said to Mrs. Keene, I said, the NFL should go to the soccer clock. I don't know what the length
commercial
would
breaks
be,
are just terrible.
What it would be. But it would be so much more of an interesting game, I think, without the slow.
And don't you think it would be quicker, Tom, because to have that kind of endurance through 90 minutes with only one break, naturally the physicality would go a little bit. You'd have to be a smaller player. It would be more nimble, agile.
John, I was on the back end of where you went both ways. You played offense and defense, so there was a lot more. But I have an immense respect for the clock of soccer. Like, let's get to it, let's go. and they still seem to make a little bit of money around it. It is the most interesting Friday. None of us were prepared for how fascinating this is. Futures up 21. NASDAQ puts on some green, not in 2 points, but the VIX in nicely. The Dow futures just barely below their high of July 6. We want to drive forward the conversation of the Washington response to this extraordinary document by the Biden administration. Terry Haynes is with Pangea Policy and the founder, and he is a student of Washington and all the white marble buildings down there. Terry Haynes, who will be most affected by this document, Republicans or Democrats?
Oh, I think affected politically. I think what Biden is doing politically is trying to shore up his left flank here. He's given progressives a lot of things that they want, and for markets, I'd say really two things. It's firstly, Biden's getting a lot of kind of bunches of good government, sure, why not sort of things, airline refunds, drug pricing, generics. But this is a long-term wet blanket on merger and consolidation activity, among other things, which as you all know, is a very large driver of the U.S. economy, and it is something that to use George Will's great definition of American football, committee meetings punctuated by violence. At least you have you'll have these long committee meetings with the regulators, and then they'll do things. But at least the market impact, I think, is mitigated somewhat by the fact that the regulators have now been given everyone a roadmap as to what they intend to do in the next 3 years, so you can at least defend against it from a market perspective.
Terry, I'm going to go all early Three Dog Night on you here and go back to 1970. We can do this with the 50th anniversary of Crosby, Stills, Nash & Young's Deja Vu as well. Terry, let's go back to 1970 in a book all of us had to read at gunpoint. Alvin Toffler. I mean, it was like you had to carry it around campus so you were cool. And the future shock of all of this was too much change in too short a time. Is this too much change for moderate Democrats to see essentially a liberal manifesto?
Well, I think there's a lot of pressure in the Democratic Party right now. And, I've been preaching four factions in Washington for a long time, not two political parties. So these two, the tectonic plates are rubbing up for a lot of different ways. But, what this does for Biden is it buys him some political goodwill with progressives. And at the same time, it takes a lot of pressure off the centrists because, they can all point to the regulatory agencies which Congress created and that by and large exercise congressional power, like the Trade Commission, and say, look, they're investigating. We can, deal with this. So in some sense, it's kind of normalizing the calls around changes in big tech and other things. So I think you see the pace of a lot of this stuff for markets, frankly, becoming more deliberate and therefore easier to defend against.
It's Terry, just in terms of this particular order, this, of course, is an executive order. But when you look at things, is there some substance here that you think Republicans might be able to go along with, particularly on the competition stuff?
Well, specifically on the competition stuff, I think not, John, because I think what's underappreciated is everybody wants to criticize, in Washington, wants to criticize big tech. It's very de rigueur to do so, but nobody agrees on the what or the how or the why. Republicans don't particularly care about the size of these companies. They're concerned about censorship and being able to make sure that points of view are put together. Whereas the principal criticism from Democrats, particularly from progressives, has to do with the size of the companies, and not so much at all with the sorts of things that they're putting out and the sorts of censorship that they're engaging in. So there's no commonality behind a lot of this stuff. So I always find this idea that big tech is under the gun to be overblown. It's definitely they're turning the barrel, but that's different than assuming that there's some sort of large imminent action that's going to happen. And even if it comes from the regulatory agencies, it'll be litigated endlessly. It's more like that 70s show is entirely apropos because it's more like the AT&T consent decree and large regulatory matters that happened in the 70s that ground on for years than it is anything quick and decisive.
Just in conclusion then, Terry, for people watching this program, listening right now, who hold some of those big names in big tech, and it might be bad, it might be good if they get broken up for those shareholders. I won't make a point on that this morning. Terry, but you think the regulatory push is just optics, there's no real substance, no teeth?
Well, I think they intend a substantive push. Yes. Do I think that there's anything in the short to medium term that ought to concern investors in that sector? No, I don't. It's headline risk and nothing else.
There's also sort of an idea here, though, Terry, some elements of this that could actually benefit workers, some elements here that maybe won't receive as much pushback than some of the competition issues themselves, meaning the headline consolidation issues. I'm wondering, with regards to some of these issues with regards to mobility of licensing, some of the right to work issues as well,
Sure.
Do you think there's the potential here that could actually make it through relatively intact?
Yeah, I do, Romain. There's an awful lot, and I'm glad you came back to that because, as I said, there's an awful lot of, kind of good government, sure, why not sorts of things here. And you bring some of them up, things that will be popular, broadly popular with voters and actually get some bipartisan support. Kind of airline refunds, drug pricing, generics are two things that come to mind. And, speaking of which, I think that the markets completely underestimate the likelihood of drug pricing reforms this fall. I have it now up to 70% that's likely. There's a big push from congressional Democrats, and Biden would certainly sign it if it came to him in a spending bill. So a lot of that stuff is just, and that's hugely popular among Republicans and Democratic voters alike. So a lot of this stuff is keyed, and appropriately if you're the White House, to make sure that they get credit for whatever it is that the regulators do, and that's fair enough since he appointed the regulators. So it has some political benefit for him. And it has some political benefit for Congress as well. And I do think some of that good government stuff happens, sure.
Terry Heinz on the executive order from the president from the White House this morning. Pangea Policy founder. Hey, Terry, it's good to catch up, sir. Thank you. Ongoing dialogue with our audience this morning on my football, you call it soccer. Okay, here's the quote. Another one. Permit me to inform that the most difficult thing to accomplish in sports is hitting a small round object traveling 95 miles an hour and hitting it 380 plus with a wooden bat, not kicking a ball the size of a watermelon. Tom, just some of the feedback I'm getting this morning. Is that hate mail? Do I call that hate mail?
That's hate mail.
That's hate mail. Thank you. Thanks for clarifying.
John, everyone should sit once behind home plate directly and watch the ball movement that comes in. You do not see it on TV. It is frightening, some of these people, 95 miles an hour plus, how when it's on radio, I'm moving my hand around. You know what I'm talking about. The ball movement's stunning.
And Tom, I've done that, and I appreciate the skill involved, and also something that surprises you once you get at that level. The arm on some of those players, that throw into third base that you see across the field.
From right field.
From right field to third base is some. When I watched, I think it was Aaron Judge, I watched do that. It was phenomenal. Yeah. Absolutely phenomenal. Do you like that little bit of baseball knowledge from Yankee Stadium for you?
And Romain, to do that at Comiskey Park, way out there in the depths of right field, is something.
Yeah, real something here. Is there a soccer chat that I'm not a part of?
It's just incoming messages from the viewers on the Bloomberg.
It's okay.
I like to be included.
You don't have
to
see
you in future.
Romain, can you get Caroline Hyde to step it up in the afternoon on English football?
I don't think that's what Romain wants, to be honest with you, Tom. Romain Bostic coming up a little bit later on the close with Caroline Hyde and Taylor Riggs. Alongside Tom Keene, I'm Jonathan Ferro.
Alarian will have an opinion.
On Monday, we'll catch up with Lisa. She'll be back from Knot Creek.
So you say.
Mohammed's going to be joining me on TV in about 20 minutes' time, alongside a whole host of guests on what's been going on in the bond market. Then on to Real Yield a little bit later this afternoon.
Anything else after Real Yield?
No, I'll be going home and having a nice little weekend. All right? Then you and I can catch up later. From New York, this...
Maybe you'll spell weekend.
...is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden is signing an executive order that will lead to new regulations on everything, from airline luggage fees to non-compete clauses. It's designed to promote competition across American industries. Regulators are being called on to increase scrutiny of tech companies, drug prices, and much more. And President Biden's team is concerned that time is running out to revive the Iran nuclear deal that Donald Trump abandoned. There have been 6 rounds of negotiations in Vienna, and there's a little sign of when a 7th might start. The stalemate is compounded by Iran's technological advances and the election of a new hardline president. China's trying to make it easier for banks to go lend to smaller businesses. The central bank has cut the amount of cash that it must hold in reserve. The People's Bank of China cut the required reserve ratio by 1/2 of 1 percentage point for most banks. That should free up about $154 billion into the economy. For now, cash is still king. At Sotheby's in Hong Kong, a 101-carat diamond was sold for $12.3 million to an unknown buyer using traditional currency. That disappointed cryptocurrency fans. They hoped the buyer would take Sotheby's up on its offer to accept Bitcoin or Ether. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I'm quite confident. I think that a lot of work has been put into these negotiations. There was a major breakthrough with the new administration on the other side of the Atlantic, obviously. And I'm confident that we will have a deal that sets the basis, for the appropriate legislation throughout the world.
The discussion at the FinMen meeting in Venice, Italy. It's actually a spirited meeting, very important for Europe as well, on taxation and such. We need to get an update. Romaine Bostic in for Lisa Abramowicz. I'm Tom Keene. Mr. Ferro getting ready to drive a market with futures up 19 forward this morning. Joining us now from Eastern Venice, the depth of Eastern Venice and the Arsenale, Maria Taddeo joins us. And folks, what's so important here to understand is that from the Arsenale, you go down past the acclaimed El Covo restaurant and you go along the canal in the water there, past the Metropole, past Daniele, and then you get over and just a little bit further after an arduous walk is Harry's Bar. Somehow Maria Taddeo will get there today. Within the celebration, Maria, what's actually getting accomplished at this FinMen meeting?
Well, look, Tom, on the one hand, it's an interesting question because a lot of the ministers here, they say they're very confident there will be a deal on taxation. They say this is really nothing short of a tax revolution that we're seeing. But actually, if you speak behind the scenes with ministers here, they still tell you there's a lot of issues that are pending here. One is a 15%. We know that for the Irish, a minimum corporate tax at that rate is very problematic. The French, they already say this morning that they want to take it even higher. For the Americans, the fact that the European Union is still going ahead with their own digital tax is problematic. And of course, all of this is happening in the context of coronavirus. Again, this new wave taking hold in Europe. So there's a lot of smiles, there's a lot of pictures happening here. Right. Of course, it's a beautiful day in Venice, but behind the scenes, there is still a lot happening here that needs to be resolved.
Is Secretary Yellen and her troop visible, or are they down at Harry's Bar?
We actually saw her with a big delegation crossing the river on the boat. You know, that boat they call Vaporetto in Italy. She was in it this morning with a big delegation. But I have to say, we haven't seen her on site. We did see, however, Christine Lagarde taking a walk. But, you know, we haven't really heard from her. We haven't really seen from her yet.
Oh, look, then the boat on radio. I mean, Romaine on radio, the boat in the background, and Maria. I mean, Romaine.
That's a very tough assignment here for Maria. Here, look at it, another one there. Maria.
But I took one for the team.
All right, let's talk about. I mean, obviously we know taxation, a big topic of discussion here. Trade policy also has to be a big topic of discussion. The idea here of keeping these borders open, and more importantly, just keeping sort of the wheels of this supply chain, this global supply chain, greased here. That has to be a concern that's going to be on the table this week.
Yeah, look, certainly, and a lot of this will also show, and the Americans in particular will want to show that this is the end of politics by tariffs. It's the end of politics by tweets, and that the United States is very much at the table with this. On that note, Romaine, however, I do have to stress the European Union is putting forward next week a digital levy. They're also putting forward a carbon tax, and there is concerns that this is going to be very difficult for the U.S. Congress to approve, that a lot of these companies are based in the U.S. will say, hey, we're being targeted just because we're Americans. So this is still very much playing in the background. Of course, again, I do have to say they do want to stress that this is a very different mood now that President Trump is no no longer in the White House.
So that raises the big point here. If we do get an agreement on taxation, if we do get some sort of agreement on trade here, I mean, how much can investors, how much can the public here expect these agreements to hold?
Yeah, look, we'll have to wait and see. And again, when you look at especially the corporate tax, what critics will tell you already is that big companies, they always find a way to reduce their tax bill. And 15% to some extent for the Europeans is actually not that much. In many of the European countries, they pay more than that. I think what is key here will be that shifting where you no longer go into low tax jurisdictions, but you're actually able to pay in the country where you make your services. That is the key for Europe in particular. It's not so much the tax rate, which should go up to some extent, but it's the fact that they will finally be taxed in European countries according to this new legislation.
Maria, I've got to ask here, after you're at Harry's Bar, you're going to go down Calavereso, I believe it is, to Celine and Balenciaga and all that. Is Venice back? I mean, is your observation there that Venice is up and running with summer tourism or not?
Well, look, that's an excellent question, and I did go, and I walked past Celine. I didn't go inside, I have to say. But the tourists right now here in Venice, they're all Americans, and that was really, to me, quite striking. Usually here you get Germans, you get French, you get pretty much a lot of Europeans in Venice. But yesterday was purely Americans, and actually I would say half the normal business that you would see around this time, and no Chinese tourists. That's a huge hit for a city like Venice.
That really is. I've actually witnessed that myself. It's just really something to see. Maria Tadeo, Tough Lifty, thank you so much, reporting from Venice this morning. Romain, let's set up the market here into a most eventful week next week. What are you going to focus on in the close this afternoon?
I think it's really a look ahead to next week. It is jam-packed. Obviously, you get the big bank earnings. You get a few earnings out of the healthcare companies. You got Jay Powell on the Hill for 2 days of testimony. I'm sure there's going to be a lot of focus there on monetary policy. And don't forget, you've got a couple key Treasury auctions coming up on Monday. And on top of that, of course, you get another read both on inflation data here in the U.S. as well as retail sales here. So investors are really going to have a lot to chew over here and really make a determination of whether this so-called growth scare that we got this week, Tom, whether that is really something you need to be worried about here going forward.
Mohamed El-Erian, he will be with John Ferro, I believe, in the next hour. I'm not sure which Ferro property Romain he'll be in, but Dr. El-Erian watching Maria in Venice and is dazzled, Romain, by the need for surveillance to go to Venice to do a remote. He says he will show up for that remote.
Yeah, I was very jealous of that shot there. I mean, absolutely beautiful out there here, and here we are stuck in this studio. I think next time I co-host here with you, Tom, it's got to be on location.
Could be Monday. We don't know if Lisa's going to be back.
Lisa will be back.
As well. Romain, the other thing I want to look at and really emphasize is these conference calls this time around will be never more scrutinized than they will now.
Yeah, everyone wants to really hear the commentary. I mean, the numbers themselves, I mean, yeah, they matter. But at the end of the day, it's really about the sentiment, not only just the forecast, but really the sentiment that we hear out of these CEOs, out of these CFOs about these businesses going forward, about how their customers are interacting with them, their clients are interacting with them, and more importantly here, just the overall tone here about the trajectory of this economy.
It will be most interesting. A special program note, and this is in the week of space that we're going to have with Mr. Bezos from Sun Valley and Idaho out to his effort up into the edges of space. Sir Richard will as well. They are doing an Alan Shepard. We can go back to Mercury and to that time where you go up and before John Glenn, not into orbit, but to get to the edge of space. We'll have special coverage of that on Sunday. Look for that as Virgin Galactic launches at 9 a.m. Really most interesting. I believe at 3 p.m. New York time also there'll be a football, soccer game. Romain Bostic may tune in. Just may. We're not sure. Stay with us on radio and television.